In this presentation, we will take a look at tax consequences of selling your home. This will be a long presentation, so if you would like to jump to relevant parts within it, take a look at the description below, which will have links to those parts and the description for them. We'll start off with an example of selling the home. We'll look at some worksheets to calculate the gain. We'll put that information into actual tax forms so you can see those tax forms. Then as we go through to different components of the calculation of the gain, of qualifications for things like an exemption, we can go back to that example problem and look at the specific components as we zoom in on them. Much of this information can be found in publication 523. In this presentation, we will take a look at an example problem related to the tax consequences of selling your home. We will start off with the type of documentation, the type of forms that we would have during this process, and we'll go through the calculations then outside of the tax forms, outside of any tax software. Then in future presentations, we'll take this information, actually put it into tax forms, see it in relation to other information such as income on the tax forms and how they interact and will play out on the tax forms. We may run some scenarios as well within the tax forms. To do that, we will use tax software. You don't need to have tax software in order to follow along, but the tax software will help us to easily make changes when we think about different components and different parts of the selling of the home calculation. The sale of the home is obviously quite complex. There's a lot of different changes and variations that could happen. As we move forward into future presentations, we'll be zooming in on particular components of either the formula or how it will be entered into the tax forms. And you can always use this as a reference to then go back to the broad overview and see what the broad view is. And then as we zoom into the particular components, you'll have a better idea of what the changes we're talking about will do with relation to the entire process. One of the documents we will most likely have when recording the sale of real estate, including the sale of the home in our case, is going to be a 1099-S, proceeds from real estate transaction. This will typically have the gross proceeds and the date of close. This is going to be important information. It's also going to be, of course, information that is provided to the IRS as well. So it should be the case that what we put in our system should line up in some way to this. And if not, we should have some reasoning as to why it would not as we go through this process. So that's one of the documents that are going to be needed. The next statement we're going to need is the settlement statement or the final closing statement. And this will be more of an intimidating type of form. We should be able to take this form and tie it out to the information, the gross proceeds, and figure out the gross proceeds from this statement. But the reason this statement is a bit confusing is a few different reasons. One, it uses debits and credits, but possibly not in the way that we're used to in financial accounting, so that's going to be a bit confusing, although we're going to have the same kind of balancing system down here. It'll still have the debits and credits being in balance. That will give us a nice check figure if we can find out a system on how we can use it for our purposes to figure out what we need for it. The other thing that's going to be a bit confusing is the relationship between the seller and the buyer and then like the escrow company, like what's going on here. And so if we go over a quick kind of recap of that as we look at the statement, it might make a little bit more sense. We know that there's an A to B transaction here, right? We have a seller and then we have a buyer. And then we have, in essence, the escrow company that you could think of as holding the information or holding the funds in a trust as all this information happens, meaning they're going to hold the money in a separate account so that to facilitate the transaction, and that's what is going to happen here. And therefore, if you think about the seller and the buyer, if we thought about something like the total consideration, for example, was $1 million here, we can think about the buyer giving the seller, the $1 million if this was a straight A to B transaction, and then the seller paying off any of the expenses, meaning the bank, the loans that they paid off, the commission to the real estate agents, any legal fees, they're going to take that money and then pay it off. But of course, that's not exactly how it happens. What happens is it's going to go into the third party, the escrow. So the buyer then puts the money into the escrow, and as everything works out for the escrow to take place, for the title transfer and all that kind of stuff to happen, and then the money to be paid out, that's what the third party is going to do. So in essence, if we have the consideration of $1 million, that the buyer puts into the escrow, And then the 1 million in this case is going to be used to then pay out whatever charges are in the process before the actual money goes out to the seller. So the seller is going to get something after net of all the expenses after it goes through the escrow. So in essence, if there wasn't any, you could think of it as, the seller really got the proceeds of 1 million and then took that and paid it all off. Of course, all that happened in escrow, however. So in escrow, they took the 1 million to the third party and then paid off whatever needed to be paid during that process. And then the seller gets the net check for whatever the net check is. So that's the first thing that you got to kind of wrap your head around when you start thinking about this. What's really happening in basically the escrow, or what is this third party that's here in this process? Once you have that, then you can kind of start to break this settlement statement down. These are going to be the types of categories that we have over here. There might be many different things under this category. So if we have like a loan, we're paying back the loan on the bank. There could be different fees that they call in the loan. Here's a loan charge fee. There could be a bunch of different like little fees that they're calling here. This is just going to be a subcategory. And what we're going to have to do is go through each of those and label them and see where they need to be in terms of our sales process. So that's what we need to do with something like a settlement statement. So same with the commission charges. They might break out the commission charges in some different format, but in essence, they're all, the commission charges are going to be to the real estate agents typically. And then legal fees, whatever the fees are for the processing of the escrow, part of the sales are typically a form of legal fees. And again, they could break that out with different names of what the legal fees are going to be. But in essence, we're going to group them into legal fees. And then we have other costs to sell the home. Again, any other cost that is in the process needing to be paid typical processes in the process of selling the home. And you can get into more detail of what exactly are the normal types of things that are going to be the other types of costs to sell the home. But we're going to list those up. Those items, in essence, you can think of the gist of the law, or the idea of the law is that if you needed the cost in order to facilitate the sale of the home, then typically it would be something that we might have to include somewhere in our sales process. And then we see the proceeds here, and this would be the cash that actually came to the seller. So when you think about the money that's going to the seller's going to say, well, I got this much, but the sales price, of course, was this much. And then other things happened, including the charges, and also paying off the loan that was on the books for the seller. The seller had two loans on the books here, and those two loans were paid off. So you can think of it again as, well, they really got 1 million within the escrow, paid off the two loans through the escrow, and then paid off all the selling charges, and were left with the $531,600. Now, with this debit and credit format, that kind of makes sense if you think about it. But if you look at this debit and credit format, a lot of people will be confused by the debit and credit format. So the first thing we want to do is kind of break this information out into a normal sales type thing. What's the normal sales? The sale would be, what's the sales price minus the cost of the sales. That's going to be our normal kind of sales calculation. So let's first take this statement. And what you want to do, I would actually put it into Excel, just like we've done. This is actually an Excel statement. You'd probably get some other statement. I would take it and put it exactly into Excel like this, whatever format, whatever it shows on the escrow statement. Add them up, sum up the two columns so we have something to deal with, and use this fact that it's in balance, and then go through each of these things and say, okay, which of these things are going to be part of basically selling expenses or something that's going to be part of the calculation, and which are not. So if we go through this, we can say, well, the paying off the loan, for example, is not going to be something that we get a benefit of. We're not going to be able to call that a selling expense because we paid off the loan. So the fact that we paid off the loan isn't gonna basically benefit us. That's just something we had to do with the proceeds. So these two aren't really helping us. The sales commission, that's something that we had to pay to process the sale. So it shouldn't be included in income. So this one I'm just going to mark off. I'm going to say, well, this one I would think would help us. legal fees, I had to pay the legal fees in order to process the sale. So you would think legal fees is something that would be an expense of the sale. And then the other costs to sell the home, any other cost that I needed to sell the home, you would think would be something that I would need to sell the home. So these three items are items that we needed to sell the home. And as we do our calculation for the gain, you would think we'd be able to take these into consideration somehow. These two, it's a little confusing when you think of the loans. You're like, why not the loans? Well, the loans just are a way that we financed the purchase of the home. We purchased the home and we took out this loan on it. So that's just a way that we financed the purchase of the loan. And therefore, it's not something that that we're going to have as helping us to lower the gain when we sell the home. So once I have this in Excel, which is basically a copy of the closing statement, then I'm going to work with this and try to keep the being in balance system in balance and start to work with what makes sense to me, and then formally put it into a worksheet that we will get from the publications so that we can double check our work. So first I would say that we have the sales price. So the sales, I'm going to say, is the 1 million, and this should typically match what's also on the 1099-S most of the time, you would think. So you're going to say, all right, well, that 1 million matches what's on the 1099-S, let's say. So I'm going to say that's going to be the sale. I'm going to make the sale with a negative because it's a credit. If that bothers people, I'm sorry. I'm going to try to keep with the debits and credits here. So the sales, not a positive sale, it's a credit. I'm going to keep the negative number here, and that'll help us to be in balance. And then we're going to say that the selling expenses, we had selling expenses, and I'm going to just basically group all these up that I colored here, because I'm going to say that these items I needed to help the sale. I didn't need to pay off the bank. They took part of that million and paid off my outstanding loan on it. Good, right? But that's not typically part of something I get to write off. These I needed to pay as part of the selling process. So you would think that I would get to have those as a selling expense. So I'm going to say that those are selling expenses. I'm going to sum those up. If I add them up, 39 plus the 6.1 plus the 2.3 is the 47.4. I'm going to do that by saying equals the sum of these items. So I'm just adding those up with a formula. I'm not getting into Excel here. So then we're just going to subtract these out. So the 1 million minus the 47.4, that's going to be the net sales. So the net sales after the expenses is going to be equal to the sum. This is subtraction problem, negative number and a positive number. So 1 million minus the 47.4 is the 952,600. So that's what I would think the net sales would be. Now again, I want to make sure that I'm accounting for everything correctly. So since I'm in balance here, I like to just have a check figure. So I'm going to put everything else that's not in my calculation here, just so I can kind of check my work and see, and make sure we're in balance. So this is what I think we need to start with, and I think we need to go from there and then figure out what the basis is. And so what I'm going to do is say, I just want to check that I have everything here. So I'm going to say this is the stuff that's not included in the process. So these are non-included items, and that's going to be the bank one, or let's say not included in my calculations, and that's going to be the loan payoff. So the loan payoffs, which are the sum of these items. So, and then the net cash proceeds, because the net cash proceeds are going to the owner, but really that they're part of the 1 million. This is the 1 million is the sales that happened. The proceeds are what actually the cash they got back after they paid off whatever had to be paid for them with the proceeds. So you can think of it as basically they got the 1 million and then paid this information off, paid all this stuff off with it, but that'll happen in escrow. So this is just basically the money they got paid to the owner of the 1 million. So, and then if we add those up, I'm going to say equals the sum of these. Then you can see that these two tie out. So that means basically we're in balance, right? So if I sum these up, we're in balance. Now the only reason, so that means this equals this. So the only reason I did that is just to show that the debits and credits are in balance. We're still in balance. I'm using this half. This is what I need to use in my calculation of the gain calculation now. So now I'm going to go down and say, okay, well that's half the formula, because that's in essence, this net sales is kind of like our sales price after the expenses of the sale, which include the sales commission and any other selling type of expenses that we needed to facilitate the sale. Now we need to figure out what the cost is, and we got to go back in time to figure out the cost, because that's happened when we purchased it. And what you really want for that is to look at the closing or settlement statement way back when, way back when you purchased the property. That's your starting point typically, and you would go through a similar process here to figure out what the purchase price was at that point. What did you pay for the property? So we're not going to go through the whole step here to do that on the cost side of it. What we're going to do is go through the steps of it. I'm going to bring down this information. This is where we're going to start at. So we got the sales. I'm just bringing this information down. And the selling expenses. So that's going to be these items. And then I'm just going to sum these up. That's going to be our top half of the formula. And then that will give us typically our, the tax code calls it, instead of net sales, they call it amount realized. So amount realized. And then we're looking for the basis. You can also call it the adjusted cost in essence. That's my terminology, but that's in essence what we're looking for. So we're going to start with the cost, the property value or the cost. And I'm going to say we bought it for, and again, we would want the settlement statement to figure this out way back when we purchased it. We're not going to have it on this information. We're not going to get any 1099 that tells us what the cost of the property we bought 20 years ago was. We're going to have to go back 20 years ago and figure out, how much did we buy this thing for? And if you don't have the records, it's public record typically, so you might be able to figure it out somehow. There should be a record of the sale usually if it's not too far back, and you could probably go back and figure out what the actual sales price was through public record. We're going to say here that it's $300,000, and then we're going to say that there were improvements. Now, we'll talk more about what improvements are, but we're going to say that these are things that are big improvements that we did to renovate the home, maybe put a new roof on it or something like that to extend the life of it. And we'll talk more about what those are, but those are going to be big in the home sale, because any improvements are good when you sell the home, because it makes the basis go up, which will decrease the gain. Note, as we go through this, we always want to have the perspective of paying less taxes, of course. So whenever we think about this, we want to think about the concept or the perspective of what would be the result of paying less taxes, because that'll keep our mindset fixed on what we're doing. And I would actually imagine thinking about talking to a tax person. If you're talking to the tax person, you could think about it. I would think about it to just exaggerate it so you have the right perspective in your mind, just to know if the taxes are going up or down. If you were, say, a taxpayer on Star Wars and you're going to knock on the Death Star's door, which is going to be like the IRS, and asking them how much money you owe, you don't go knocking on the Death Star door looking like a rich person driving up your very expensive spaceship or whatnot. You want to look like, obviously, you want to look, the money needs to be less, right? And the same is true when you're thinking about the income, of course, from a tax perspective. We want to do everything legally possible to have the income typically be lower, because if you have lower income in an income tax system, that's going to result in paying less taxes. So what does that mean then? Well, to have a lower gain on the sale, that of course means that either sales are lower, and the sales pretty much are what they are, because sales are reported here on the 1099. So, it is what it is for the most part. Or the basis is higher, meaning, I got $1 million here, but it cost me a lot of money. This is a big piece of property. So our goal here is to make whatever legitimate basis increase that is there, improvements that we can have, would increase the cost, and that would lower the sales minus the cost, which would lower the gain, the profit, which would lower the income taxes, because obviously we're taxed on the income. So anything that's going to be a legitimate improvement we want to basically list out the legitimate improvement and say, yeah, this cost a lot, and therefore the gain that we got on sale, it's not like it was a genius investment and we got a lot of money. It's just we bought something that was expensive and we sold it something that was fairly expensive, right? The improvements would make the basis increase. So we'll talk more about what improvements are, what qualifies for an improvement as opposed to an expense. And you want to make sure you're, of course, we're wanting to be in compliance, but to have like an extreme view in your mind on the perspective can help you to think about, not get turned around. Because when you think about financial accounting, of course, the opposite is true. It's like you're going around trying to show off to how much money you have because you're trying to attract investors. So in that situation, you're going around talking to investors, driving, a very fancy spaceship that you don't even own because you borrowed money for it, right? It's a different perspective here. And again, you do everything possible to look good in that situation typically. And here we do what we do to not look good. And so that's going to be the kind of a flip scenario in taxes. So if we were then to take this, then we're going to have the basis and that we have left over. So if I copy this, we're going to say the basis then will be equal to the sum of these items, and that's going to be the 320,000, and then that's going to give us the gain on sale. So we'll have the gain on sale then, which is going to be the amount realized minus the basis here. So I'm going to put this, I'm going to underline this. So it's going to be equal to the sum. This is a subtraction problem. The 952.6 minus the 320, that will give us our gain. So we're going to say, well, yeah, we sold it for $1 million, but really the net amount realized was 952 after the selling expenses minus the cost. It's at the 632,600. Now there's an exemption if it's a home sale that the government gives us, and if we're married filing joint, it's up to 500,000, which is huge. So that's what a lot of our discussion when we talk about a home sale is going to be related to this exemption. Notice where it is on like the calculation. That would leave us with a gain after exemption. And that's going to be the sum of these two, meaning the 632.6 minus the 500,000. So even on this huge sale, we really are only paying taxes possibly here after this giant exemption, if we're married filing joint, of 132,600. And then we would possibly be paying taxes even at a lower rate, a capital gains type rate, possibly. So note there's huge tax benefits to selling the principal residence, selling the principal home. So a lot of our talk then is going to be about this 500,000 because many people will not be over that 500,000. And then of course, if you're not over this exemption, then you may not have to pay any taxes if it's your home sale. So our main goal then, a lot of our discussion is going to be about, do we qualify for this 500,000 married filing joint? Do we qualify for the 250,000 if you were single or some other filing standard? Do we qualify for some kind of partial amount of that if there's any special circumstances? And we're always talking about this item way down here. And notice it's not even the sales price, because you might be thinking, well, yeah, but if I sold my home for something like $1 million, the 500,000 is not going to cover it. But if you take into consideration the selling expenses and the cost and improvements, we're really talking about the gain after those things happen, which in our case was 632.6. So the 500,000 will eliminate the gain for a lot of sales, clearly. If it's married filing joint, 250 will eliminate a lot of gain for a lot of sales. So as we go forward, just note where this is in the calculation. We're not talking about an exemption that you're going to be comparing to the sales price. You're talking about the exemption as it's compared to the net gain after we've taken into consideration the selling expenses and the basis, the cost of the home, plus any improvements. So that 500,000 is much more likely than to wipe out. It wouldn't, obviously in this case, it wouldn't have wiped out the proceeds, because the proceeds on here, we would say, well, that was $1 million. 500,000 is not going to wipe that out, but we could easily have bought the home for something close to that. In that case, the exemption would wipe it out. So we're left with this amount here. Now, the next time we'll go through this and we'll use the IRS's worksheet 2, which is a similar process, and we'll go through this line by line and think about it in our worksheet. And then when we go through our discussions, we'll talk about some of these line items as we go through our discussions. In this presentation, we will continue on with our example problem related to tax consequences of selling your home, this time actually looking at the tax forms. In prior presentations, we took a look at the forms we would need in order to figure the gain on the sale of the home. One of those being the Form 1099-S, which is going to be the proceeds from the sale of the real estate transactions. We also took a look at a mock settlement statement, a closing type statement for the sale of property, the sale of the home. We then took a look at how to have a short type of calculation to figure out what the gain or loss would be, as well as an estimate of what the exemption amount would be and the gain or loss after that amount after the exemption. And we've took a look at a worksheet, which is going to be a simulation of the worksheet that can be found in publication 523, Selling Your Home, under worksheet 2, which is in essence the same formula we have here, but we broke it out to all the categories. So we can see all these different types of categories, and these of course are the types of variations we'll have in different scenarios. So when we go into different scenarios, you want to look at this worksheet and say, okay, well, where does this fall into with regards to this calculation? Where does it fall into which line item in this kind of simplified calculation? And therefore, what will be the impact on the gain or loss, or the exemption, or the gain after the exemption, and therefore the effect on the taxes. Now we're going to take this information and in essence put it into the tax return. So the bottom line we had in this information is we had the sales of the 1 million. Then the selling expenses were all the other stuff, including the commissions, the legal fees, the other fees related to selling. And again, look at prior presentations to kind of think about how you might figure that out with regards to just a settlement statement. And that's going to give us the amount realized. And then we had to take the basis. And this is the other thing we're going to have to enter into the tax return, which we figured was the cost that we purchased for the home. We're going to say like 20 years ago, we purchased the home for $300,000, we're going to say, and improvements, we're going to say we put a new roof or something on it, $20,000. That's the adjusted basis. That'll give us the gain. And then the exemption, married filing joint, we're going to say is $500. And that's, we would expect then the tax return to have $132,600. So what does it look like if we have to input this into the tax return? Then how do we do that? Okay, so let's go to the tax return. We're going to say this is going to be our test 1040. We're going to have a married filing joint return. So we have a married couple here, and this is just going to be a mock 1040. As we scroll through, we see that there's income, other income of the $100,000. We're saying W-2 income of the $100,000. We're going to record our information on the gain on the sale on top of course, just the normal W-2 income. That is typically recorded on the Schedule D. Schedule D is capital gains and losses. You might recognize the Schedule D if you sell something like stocks and bonds, then the sales typically go on the Schedule D for capital gains and losses. The sale of property typically falls there as well, home being a type of property, and so it's going to be on Schedule D, and there's going to be that added kind of special factor, which of course is the fact that we might have this exemption that we have to apply to it. So if we scroll down to the Schedule D, we're going to put that in the Section 2, long-term capital gains and losses typically. And we've got the proceeds. So the proceeds, if we just consider this from our formula, we'll say, all right, well, the proceeds were 1 million. We're going to say that's here, and that's going to be the amount we typically would find on the proceeds from the real estate transactions in general. So we'll put that there and say that's the 1 million. And then we have these costs. Cost or other basis, and that's going to be the amount we calculated at the cost plus the 320 or the 320,000, the cost plus the improvements in our case. So there's the 320, and that's going to give us the adjustments to gain or loss from 8949 Part 2. If we go to Form 8949, here's Form 8949 Part 2. We've got the date acquired. We're going to say it's in 2000. We've got the date sold. It's going to be sometime in the current year, of course, because we sold it in the current year. We're saying 2018. Proceeds, and then the basis. And then we have the amount of adjustments. And the amount of adjustments is a little bit confusing. If we go back to our information here, we're going to say, well, what is that amount of adjustment? Well, we know we had an adjustment for the selling expenses we haven't taken into consideration, which is the $47,400. And then we have this exemption that could be possible of the $500,000. That's going to give us the $547,400. So if we go back to our form, then we have the amount of adjustment, which is the $547,400. So then if we calculate this out, we've got the 1 million minus the 320,000 minus the 547,400. That's going to give us our 132,600 gain or loss subject to column E, as we see here. And that of course lines up to our calculation that we have in our worksheet. If we go back to Schedule D, we'll see that we also have a worksheet here. So we have a worksheet for the sale of the home. So if we open that up, we'll see a similar type of calculation. Part 1, this is very similar to the calculation within the publication. We have the gain or loss on sale. We have the sale price of the home, the 1 million. Selling expenses were the 47,400. Subtract line 2 from 1, and we get the 952,600. So there's the 952,600 that we saw in our calculation. And then we have 4 adjusted bases of the old home, 320. So there's the 320, which is the cost plus the improvements of the 320. And so that's the adjusted basis of the old home, gives us the gain or loss on the sale. Subtract line 4 from line 3. So we subtract those out, and that gives us, of course, the gain or loss, the 632,600. So there's the 632,600. Part 2, exclusion and taxable gain. So now we figured out the gain. Again, here's the gain. Now we're figuring the exclusion. Do we get an exclusion on it? So we have line 6, enter any depreciation allowed or allowable on the property for periods after May 6. Line 7, we have subtract line 6 from line 5. So we're bringing this item down. I'm going to skip down to line 12 because there's no effect. So line 12, we have the same line brought down. And then in line 13, here we have the maximum exclusion. If qualified for a reduced exclusion, enter the exclusion from the reduced exclusion worksheet. Line 7, if not qualified to exclude gain, enter 0. So we have the 500 because we're saying that there's no restriction to it, and 500 is the max for married filing joint. And then of course, line 15 says taxable gain. Subtract line 14 from line 5, and that's going to give us, this amount of the 632 that we're going to subtract out minus the 500,000, line 14 minus or line from line 5. So if we go all the way back up to line 5, same number, 632,600 minus the 500,000 gives us the 132,600. And that of course is our gain after the exemption amount. And that amount then will flow to page 2 in the part 3 in the summary. It'll also go up to Schedule 1. So this is a new schedule in 2018 where we have line 13, which shows the capital gain or loss, where it says attach Schedule D if required. If not required, check here. So we have the Schedule D attached. We just looked at 132,600. That then sums up down here and is then brought over to the form 1040. So within the 1040, we had 100,000. This is W-2 income. Then we see this 132,600 that was pulling over from Schedule 1, the new schedule in 2018, to give us the income of 232,600. So there's the 232,600. We have the standard deduction for married filing joint, 24,000, and that's going to give us, if we subtract those out, the 208,600. And then we've got the income tax calculated by the software, 28,452. And note that calculation could be a little bit tricky because we might have different rates now on it, considering we have Schedule D capital gains. But we have that calculated here, and that obviously pulls down, and that's going to be our tax. We're not looking at any kind of payments made in this process. We're just calculating the liability. Just note once again that the calculation of the tax may be a little bit more complicated than even just the normal progressive system. If we take a look at a worksheet on the calculation of the tax, just to get an idea of it, we have line 1, enter the amount from form 1040, line 10. So 1040, line 10 is going to be the taxable income, including the amount on Schedule D, the gain on the sale, as well as the amount of income. And then we had Line 3 saying, are you filing a Schedule D? We are, because that's where we report the sale of the home. So we're going to say yes, enter the smaller of line 15 or 16 of Schedule D. There's our 132.6. So here's our 132.6. That was our gain after the exemption. If we scroll down to line 7, subtract line 6 from line 1. If 0 or less, enter 0. So in essence, we're taking the taxable income minus the amount on the Schedule D, and that's going to give us the 76. And then line 8 says enter 38.6 if single or married filing joint, 77.2 if married filing joint or qualified. So here's the 77.2. Line 9 says enter the smaller of line 1 or line 8. Line 11, it says subtract line 10 from line 9. This amount is taxed at 0. So there's the 1,200. Line 12 says enter the smaller of line 1 or line 6. So we got the smaller of 1 or 6, the 132.6 here. Enter the amount from line 11. So that's going to be the 1,200 that was taxed at 0. Subtract line 13 from 12. That's going to be the 131.4. And now we have 15 says enter 425,800 if single, 239,500 if married filing separately, and 479 if married filing joint. We have the 479. And then 16 says enter the smaller of line 1 or line 15. So we have line 1, which of course is this item up top. And then line 17 says add line 7 and line 11. 18, subtract line 17 from line 16. If 0 or less, enter 0. Line 19, enter the smaller of line 14 or line 18. And then multiply line 19 by 15%. So we took that line 19, multiply it times the 15%. And then 21, add lines 11 and 19. Subtract line 21 from line 12, multiply line 22 times 20%. And so you can see this is our progressive tax rate in action. 24, figure the tax on the amount on line 7. And then we'd have to use the tax tables to tax the computation worksheet. So line 7 is up top here. And remember, that's basically our amount that is the difference between the taxable income and the Schedule D income. And we had to use the tables to calculate that. And then add lines 20, 23, and 24. Figure the tax on the amount on line 1. Use the tax tables to compute the worksheet. Tax on all taxable income. So notice the calculation again. I read through that just to show that it's a bit complex of a calculation. Also note that it's going to be a progressive type system, and we have the added factor if we have the capital gains tax possibly, which confuses this system. If you then go to like a summary, so when you think about, well, what's the average, you may see an average tax rate, which would be the average rates of all the progressive types rate systems, and the marginal rate, which is usually the highest rate. But just realize when you're talking about the capital gains that it's outside, you have a different type of system that you'll be looking into to figure out what the capital gains rate will be. So in general, when you start to think about the types of things that will affect the gain formula and whether or not you have the exemption, and considering what's going to happen to the total taxes, your first instinct might say, well, let me take the average tax rate and see what that will be. But the capital gains rate may be different from that. Your second instinct might be, well, I should take the highest rate because now the new tax dollars in the progressive system will typically be at the highest rate. They'll be the last dollars that are coming in. And usually when you do tax planning and income goes up, then you're thinking, well, I want to look at the highest rate because now that's what I'm going to be taxed at. But just realize that the rates for the capital gains could differ than the highest rates as well. They're typically favorable types of rates. And therefore, as you consider what's going to happen to things like the capital gains or the exemption, then you want to be careful on which rate you're going to apply in order to apply the actual tax effect, what's going to be the impact or the increase in taxes as we think about different scenarios and changes in things like the gains or the exemptions related to the capital gains and related to selling of the home. In this presentation, we will take a look at an introduction of tax consequences related to selling your home. This information can be found in publication 523. Introduction. This publication explains the tax rules that apply when you sell or otherwise give up ownership of a home. If you meet certain conditions, you may exclude the first $250,000 of gain from the sale of your home from your income and avoid paying taxes on it. The exclusion is increased to $500,000 for a married couple filing jointly. So this is going to be a huge exclusion, of course, the 250 or the 500,000 if we are married filing joint, or if we are something other than married filing joint. We'll get into more of the specifics of those exclusions in future presentations. Back to the text. This publication also has worksheets for calculations related to the sale of your home. It will show you how to 1. Determine if you have a gain or loss on the sale of your home. 2. Figure how much of any gain is taxable. And 3. Report the transaction correctly on your tax return. Obviously, the reporting of a sale of a home has a lot of components to them. We'll discuss many of them as we go forward in future presentations. In this presentation, we will discuss the question of, does your home sale qualify for the exclusion of gain? This information can be found in publication 523. Does your home sale qualify for the exclusion of gain? So clearly, whenever we think about the home sale, we're going to be thinking about that exclusion. We're going to be thinking about, is there going to be a gain on the sale? What are going to be the tax consequences? And we would like to be qualified for that exclusion typically, which is up to $500,000 for married filing joint, or $250,000 for something other than married filing joint, such as single or head of household. So we want to think about the requirements for whether or not we qualify for that exclusion with relation to the sale of the home. Back to the text. The tax code recognizes the importance of home ownership by allowing you to exclude gain when you sell your main home. To qualify for the maximum exclusion of gain, $250,000 or $500,000 if married filing jointly, you must meet the eligibility test explained later. To qualify for a partial exclusion of gain, meaning an exclusion of gain less than the full amount, you must meet one of the situations listed in Does Your Home Qualify for a Partial Exclusion of Gain later. Before considering the eligibility test or whether your home qualifies for a partial exclusion, you should consider some preliminary items. Transfer of your home to a spouse or an ex-spouse. Generally, if you transfer your home or share of a jointly owned home to a spouse or ex-spouse as part of a divorce settlement, you are considered to have no gain or loss. So note that when you think about the spouse or ex-spouse, when someone is married, when two individuals are married, the exchange between the married couple isn't typically considered a taxable item, because when married, the two items, the two people, are taxed as if, in essence, one person. So an exchange from the property from one to the other between two married individuals then doesn't typically have a tax effect. Now, if it's part of the divorce agreement, if it's a settlement within the divorce settlement, then what is happening there is you've got the principal property, including the home, that is now changing or is now being split back up. It's going to go from one ownership, the tax seeing it as one ownership, to then dividing between the two later on the two tax returns from the perspective of the IRS. What didn't happen was a sale in that case, and therefore you don't typically have to worry about the calculation of a gain or a loss on the sale. Now, if something happened later on, if it wasn't part of the divorce agreement and there was some type of transaction that happened outside of the divorce agreement at a later time period, you might have to look into that. But if it's part of a marriage between two individuals and it's a transfer of property in one form or another, then typically doesn't have tax consequences. And if it's part of the actual divorce settlement, then that's you really taking joint property or property that is owned through marriage by both individuals, at least from a tax standpoint, and then it's breaking that up to two separate individuals that'll be taxed separately. Not typically a sales type transaction, not typically a taxable event. Back to the text. You have nothing to report from the transfer, and this entire publication doesn't apply to you. However, there is one exception to this rule. If your spouse or ex-spouse is a non-resident alien, then you likely will have a gain or loss from the transfer, and the tests in this publication apply. Home's date of sale. To determine if you meet the eligibility test or qualify for partial exclusion, you will need to know the home's date of sale, meaning when you sold it. If you received Form 1099-S, proceeds from real estate transactions, and typically we will have that. We typically will, in the process of selling the home, receive a 1099-S. Back to the text. The date of sale appears in box 1. If you don't receive the Form 1099-S, the date of sale is either the date the title transferred or the date the economic burdens and benefits of ownership shifted to the buyer, whichever date is earlier. In most cases, these dates are the same. Sale of your main home. You may take the exclusion whether maximum or partial only on the sale of a home that is your principal residence. This is going to be a key term here. It's your principal residence, meaning your main home. An individual has only one main home at a time. So think about that in terms of the code here. As we go through the rules, the IRS sees that you might have multiple places that you own, multiple properties, multiple homes, but the IRS only sees one home as, in essence, your principal or main home during a particular time period. So keep that in mind as we start to think through these regulations and whether or not that home qualifies as the principal or main home. Back to the text. If you own and live in just one home, then that property is your main home. So clearly, in a lot of cases, it's pretty straightforward. If we have one home and we live in it, then there's not much question as to whether it's our main home or not. It's when we have multiple homes or when we're moving around, something a bit more unusual, where we have to get into more specifics and define what does it mean to have a main home or a principal home versus other properties that may not be our main homes or principal home. Back to the text. If you own or live in more than one home, then you must apply a facts and circumstances test to determine which property is your main home. So now we got the consideration, well, what if we live in multiple places? Well, we have to use the facts and circumstances test. And you could see by the quotes that you're probably thinking that might be not the easiest test, or it could have some gray area in terms of how does that apply in different types of situations. We can imagine different types of situations where we have to apply these circumstances and it's not as clear as to which home is our main home or not. Back to the text. While most important factor is where you spent the most time, other factors are relevant as well. So typically, of course, it would be, well, where do you spend the most time? Where do you actually spend the time that, in essence, living in your home or your principal place? But there are other factors as well. They are listed below. The more of these factors that are true of a home, the more likely that it is your main home. So when you're considering the exclusion, of course, we want to make sure that more of these are true, and we want to have evidence for that so that we can make sure that we can take the exclusion and be able to explain the reason why this is our main home, and therefore we qualify for the exclusion. So these are some factors. The address listed on your home. 1. U.S. Postal Service address. 2. Voter registration card. 3. Federal state tax returns. And 4. Driver's license or car registration. When thinking about these type of items, it's best to think of them as if we were to see an audit or to have an audit. So in other words, if the IRS came and questions the exclusion as to whether it is our principal residence or not, and they may do this basically randomly. They could just have picked an audit and then they're going to ask some questions about the exclusion. Well, then we want to say, well, what type of evidence can we give in order to prove that it is our principal evidence or our principal residence? What the IRS would often be looking for are things that are going to be mailed to us and things that are going to be mailed to us with regard to basically U.S. or state things that will be mailed to that address as some partial evidence as to whether it is our principal residence or not. So the U.S. Postal Service address, of course, is something that would be an indicator typically of our principal residence. The voter registration card, if that's going to that address, to our home, to our principal residence, that would be a good indication as well. And we would want to keep these things just so we can show, hey, look, this is where the mail's going. So that would be a good indication that it's our principal residence. Federal and state tax returns. So obviously the address on the federal and state tax returns, given the fact that it's the IRS and they have those, would be an indication to them whether or not it's your principal residence or not. So in other words, if you're filing taxes that haven't had that home that you're taking the exclusion on as your principal residence on the tax return that you've been filing for the prior years, it doesn't mean that you're going to get audited for sure or anything like that, but it just means that if you look at it, if the IRS was to look at it, they would then say, well, they might ask the question within an audit, well, this isn't the address that you used on your tax return. Is it your principal residence? Could you give us some evidence that it is your principal residence? And note that it's not included on the tax return. So that is one thing that isn't included. That doesn't mean it's not your principal residence for sure, but it is one thing that the IRS automatically already has. And if the principal residence on prior tax returns doesn't match the principal residence of the home that was sold, they might ask for other evidence, like a driver's license or car registration. Again, things that come from the state, from the government, or the federal government, or the state government, are things they tend to rely on more. The home is near where you work, so this would just make sense. If the home was close to where you would work, you could use that as evidence. You could say, hey, look, I live here out of convenience. That's why I live here. And then where you bank, the resident of one or more family members. So these are some more evidence that we can give. And you can imagine in the circumstance of an audit, we could say, hey, look, it's our principal residence. It's right where I work. That's why I spend time here. I might have my mail going somewhere else, possibly, if some of these items don't line up. But maybe you can make the argument that the mail's going there for some reason. And we actually are here most of the time because that's where we work, that's where we bank, and that's where it's close to the family members. And recreation clubs or religious organizations of which you're a member. So we could say, hey, look, I'm a member of these clubs and organizations. I frequent to these areas, and that would give evidence that I must live close to this area. And that would give some evidence as to one particular place versus another. The exclusion can apply to many different types of housing facilities: a single family home, a condominium, a cooperative apartment, a mobile home, a houseboat. Each may be a main home and therefore qualify for the exclusion. So if we think about a home, we might imagine just a fixed home, a principal family residence, but many different things. If it's your principal place, your principal home, can qualify even though it's not a standard home that we might think of as just a set home. Could be something like a mobile home as referenced here, or even a houseboat as well. In this presentation, we will take a look at an eligibility test with relation to tax consequences for selling your home. This information can be found in Publication 523. Eligibility test. The eligibility test determines whether you are eligible for the maximum exclusion of gain, which is the $250,000 or the $500,000 if married filing jointly. In other words, if married filing jointly, could be up to the $500,000 if something other than married filing jointly in filing status, which would include head of household or single, the $250,000. Eligibility step 1, automatic disqualification. Determine whether any of the automatic disqualifications apply. So these are going to be items that obviously would disqualify automatically. First step in our process. Back to the text. Your home sale isn't eligible for the exclusion if any of the following are true. You acquired the property through a like-kind exchange. You acquired it through, in other words, a 1031 exchange during the past 5 years. If that is the case, see Publication 544. Sales and other disposals as assets. For more information, you can go to the IRS website at irs.gov. Take a look at Publication or PUB 544. You are subject to expatriate tax. For more information about expatriate tax, see Chapter 4 of Publication 519, U.S. Tax Guides for Aliens. And both of these are more unusual types of things to have happen. So a 1031 exchange, not the most typical way that someone would be acquiring or have possession of the home. And this expatriation tax, again, if you're subject to the expatriation tax, you want to go to Publication 519. Not the most common type of thing for most people when they have the home sale. If any of these conditions are true, the exclusion doesn't apply, and you could skip to figuring gain or loss later. Eligibility, Step 2, Ownership. Determine whether you meet the ownership requirement. If you owned the home for the last 24 months, 2 years out of the last 5 years leading up to the date of sale, date of the closing, you meet the ownership requirement. For a married couple filing jointly, only one spouse has to meet the ownership requirement. So that's going to be a key point here. If you're married filing joint, you only need one spouse, one of the two spouses, to meet the ownership requirement. Eligibility, Step 3, Residence. Determine whether you meet the residence requirement. If you owned the home and used it as your residence for at least 24 months of the previous 5 years, you meet the residence requirement. Let's read that again because this is a requirement that often is applicable or something that might be a question for many people. If you owned the home and used it as your residence, so you used it as your residence for 24 months, which of course is 2 years if you break that into years, 2 months of the previous 5 years, you meet the residence test. Now you could break that up. You can think, all right, well, 24 months out of the last 5 years. What does that mean if I was moving around or something like that? And you could see different scenarios with this particular requirement. Back to the text. The 24 months residence can fall anywhere within the 5-year period, and it doesn't have to be a single block of time. So that's going to be not as restrictive as it could be. It doesn't have to be a single block of time. It doesn't have to be the exact 2 years prior to or the 24 months prior to the time of sale. It has to be within the 5-year period. Back to the text. All that is required is a total of 24 months or 730 days of residence during the 5-year period. Unlike the ownership requirement, each spouse must meet the residence requirement individually for a married couple filing joint to get the full exclusion. So keep that in mind with the married couple. If you were ever away from home, you need to determine whether the time counts towards your residence requirement. A vacation or other short absence counts as time you lived at home. So if there's just a short absence, if you're going away from home and it's a vacation or a short absence, then that time counts as if, in essence, you lived in the home. That's not something you have to count as if you have a separate residence if you were on vacation, even though you weren't technically in the home. It's still, in essence, your principal residence. It's still where the mail goes. It's still where everything is going to, as basically your primary residence. It probably meets many of the tests that we looked at in a prior slide in determining what is a principal residence or not. Back to the text. This is the case even if you rented out your home while you were gone. If you became physically or mentally unable to care for yourself, you only need to show that your home was your residence for 12 months out of the 5-year leading up to the date of sale. In addition, any time you spent living in a care facility, such as nursing home, counts toward your resident requirement, so long as the facility has a license from a state or other political entity to care for people with your condition. So there's going to be this exception if we have become physically or mentally unable to care for ourselves, and we have the 12 months out of the 5 years. And also, there's going to be, of course, leeway if we're at another place that was helping with our caretaking, and therefore that's where we're going to be obviously spending most of our time. We may still be able to count our residence or our home as our principal residence, even though in that case we're going to be spending a lot of time in a care facility. Eligibility, Step 4, Look back. Determine whether you meet the look back requirement. If you didn't sell another home during the 2-year period before the date of sale, or if you did sell another home during this period but didn't take an exclusion of the gain earned from it, you meet the look back requirement. You may take the exclusion only once during a 2-year period. So in other words, if we take the look back time, the IRS is saying you don't want to see a double up on this type of exclusion. So if we took an exclusion in the prior 2-year time period, then that would be something that would restrict us possibly from taking the exclusion in this time period. And you could see situations where we have the last 5 years that if we're considering our principal residence as any 2 of the last 5 years, it's plausible that we have 2 residents that fall into that category, and then we can end up viewing the sale that happens 2 times and possibly having this exclusion. Well, the IRS is saying no, there's going to be a look back period of 2 years in essence, meaning you can't qualify for the exclusion again within a 2-year time period. Eligibility, Step 5. Exceptions to the eligibility test. There are some exceptions to the eligibility test. If any of the following situations apply to you, read on to see if they may affect your qualification. If none of these situations apply, skip to Step 6. A separation or divorce occurred during the ownership of the home. So we could see the separation or divorce taxpayers. Of course, that can result in some kind of unusual situations that we would have to look into when seeing whether or not we qualify for the exclusion. Next item, the death of a spouse occurred during the ownership of the home. Again, we could see different types of scenarios where that could be questions could arise in terms of our qualifications in that scenario. The sale involved vacant land, so if there was vacant land included within the home sale, then there may be some exceptions that we need to look into. We can see vacant land next to home in a later section. You owned a remainder interest, meaning the right to own a home in the future, and you sold that right. See the remainder interest. So this would be an unusual type of situation or a different type of situation where we have a remainder interest. Your previous home was destroyed or condemned. So if it was destroyed or condemned, we could see home destroyed or condemned, considerations for benefits. You were a service member during the ownership of the home. Then we could see the service, intelligence, and Peace Corps personnel. You acquired or are relinquishing the home in a like-kind exchange. We could see the like-kind exchange, otherwise known as a 1031 exchange. Separated or divorced taxpayers. If you were separated or divorced prior to the sale of the home, you can treat the home as your residence if you are a sole or joint owner and your spouse or former spouse is allowed to live in the home under a divorce or separation agreement and uses the home as his or her main home. If your home was transferred to you by a spouse or ex-spouse, whether in connection with a divorce or not, you can count any time when your spouse owned the home as time when you owned it. However, you must meet the residence requirement on your own. Widowed taxpayer. So we have the widowed taxpayer. That's going to be a filing status. If you were a widowed taxpayer who doesn't meet the 2-year ownership and residence requirement on your own, consider the following rule. If you sell your home within 2 years of the death of your spouse and you haven't remarried at the time of sale, then you may include any time when your late spouse owned and lived in the home, even without you, to meet the ownership and residence requirements. So if we're filing as a widowed taxpayer, then widow or widower, then we can look into to meet some of these tests to the rules or the time period that our spouse was a resident of the home as well. Back to the text. Also, you may be able to increase your exclusion amount from $250,000 to the $500,000. So the $500,000, which would typically be for the married filing joint status, may apply to the widow or widower status on the tax return. Back to the text. You may take the higher exclusion if you meet all of the following conditions. 1. You sell your home within 2 years of the death of your spouse. 2. You haven't remarried at the time of sale. 3. Neither you nor your late spouse took the exclusion on another home sold less than 2 years before the date of the current home sale. So you got the same kind of look back type of requirement to both yourself and the spouse. 4. You meet the 2-year ownership and residence requirements, including your late spouse's times of ownership and residence if need be. Service, intelligence, and Peace Corps personnel. If you or your spouse are a member of the Uniformed Services or a foreign service or an employee of the intelligence community in the United States, you may choose to suspend the 5-year test period for ownership and residence when you're on qualified official extended duty. This means you may be able to meet the 2-year residence test even if, because of your service, you didn't actually live in your home for at least 2 years during the 5-year period ending on the date of sale. So clearly there's going to be an exception for the 2-year living requirement for service, intelligence, Peace Corps that possibly are on duty for the job and therefore not actually living in the home. Qualified extended duty. You are on qualified extended duty if you are called or ordered to active duty for an indefinite period or for a definite period of more than 90 days. You are serving at a duty station at least 50 miles from your main home, or you are living in government quarters under government orders. You are one of the following: a member of the Armed Forces, Army, Navy, Air Force, Marine Corps, Coast Guard. 2, a member of the Commissioned Corps of the National Oceanic and Atmospheric Administration, the NOAA, or the Public Health Service. 3, a Foreign Service Chief of Mission, Ambassador at Large, or Officer. 4, a member of the Senior Foreign Service or the Foreign Service Personnel. 5, an employee, enrolled volunteer, or enrolled volunteer leader at the Peace Corps serving outside the United States. Or 6, an employee of the intelligence community, meaning A, the Office of the Director of National Intelligence, the Central Intelligence Agency, the National Security Agency, the Defense Intelligence Agency, the National Geospatial Intelligence Agency, or the National Reconnaissance Office. In this presentation, we will discuss a situation of vacant land next to the home with regard to tax consequences for selling your home. This information can be found in publication 523. Vacant land next to home. You can include the sale of vacant land adjacent to the land on which your home sits as part of a sale of your home if all the following are true. So all of these must be true, as is emphasized here. First item, you owned and used the vacant land as part of your home. The sale of the vacant land and the sale of your home occurred within 2 years of each other. Both sales either meet the eligibility test or qualify for partial tax benefits as described earlier. Also, if your sale of vacant land meets all of these requirements, you must treat that sale and the sale of your home as a single transaction for tax purposes, meaning that you may apply the exclusion only once. However, if you move your home from the land on which it stood, meaning you relocate the actual physical structure, then the land no longer counts as part of your home. For example, if you move a mobile home to a new lot and sell the old lot, then you can't treat the sale of the old lot as the sale of your home. So see how that would work. Obviously, if we had the mobile home on the lot, we moved the actual home to another lot and sold the land that it was sitting on, the IRS is saying, well, that the land isn't your home. They're saying, in essence, then the mobile home, the structure would be your home, and therefore may not be able to take the exclusion on just the sale of the land if the actual home was moved off of it. Back to the text. Home destroyed or condemned, considerations for benefits. If an earlier home of yours was destroyed or condemned, you may be able to count your time there toward the ownership and residence test. If your home was destroyed, see publication 547, Casualties, Disaster, or Theft. If your home was condemned, see publication 544, Sales and Other Dispositions of Assets. So those are going to be obviously special kind of circumstances. You can find these publications on the IRS website, irs.gov. Publication, type in pub or publication 547 or 544, whichever applies to you. Remainder interest. The sale of a remainder interest in your home is eligible for the exclusion only if both of the following conditions are met. The buyer isn't a related party. A related party can be a related person or a related corporation, trust, partnership, or other entity which you control or in which you have an interest. So notice when we think about the related person, we often think about family members as a related person. Obviously, related people as well from a tax standpoint. The IRS is very skeptical if there's any kind of control, if we have control over the related interest. Obviously, if we're talking about something like some type of entity that we have ownership or control in, then that could be a related interest in that sense as well. Back to the text. You haven't previously sold an interest in the home for which you took the exclusion. In this presentation, we will take a look at like kind or 1031 exchange as it relates to tax consequences of selling your home. This information can be found in publication 523. Like-kind 1031 exchange. So the like-kind 1031 exchange, first of all, the 1031 exchange is going to be the code section. The like-kind exchange is another word for it. So the 1031 exchange, like-kind exchange, two words for, in essence, the same thing. Back to the text. If you sold a home that you acquired in a like-kind exchange, then the following tests apply. So these tests only apply if you acquired the home through a like-kind type of exchange. You can't claim the exclusion if 1. Either A or B applies. A. You acquired your home in a like-kind exchange, also known as a Section 1031 exchange, or B. Your basis in your home is determined by reference to a previous owner's basis, and that previous owner acquired the property in a like-kind exchange. For example, the owner acquired the home and then gave it to you, and you sold the home within 5 years of the date your home was acquired in the like-kind exchange. So you can see how this might apply out. If we had a 1031 exchange, the 1031 exchange typically is something that we can't use in order to get the exemption. Well, what if there's a case where there was a 1031 exchange, but the home was then gifted to the person who had the 1031 exchange to some other person, and then you had the home sale? Well, when there's a gift that happens, typically the gifted property is going to have the same basis as the basis of the prior owner as part of the gifting process, and therefore you still could be restricted from taking the exclusion with regards to that situation. You can see how this could play out, right? If you have a 1031 exchange, your question in terms of the tax process might be, well, I cannot qualify for the exemption possibly as a 1031 exchange. So you could see a taxpayer saying, maybe I should gift it to someone else, possibly a relative, and then the relative would have it not as a 1031 exchange and therefore wouldn't be restricted from this particular restriction, and they can then try to sell the home and have the exclusion. But again, there is going to be limitations with that as well, as we can see here. You can see how that process would roll out. If that's a situation that's particular to you in terms of a 1031 exchange, you might want to do some more research on that particular situation. It is a kind of a more of a unusual type of situation with a home sale. So for more information about like-kind exchanges, you can go to publication 544. So you can go to the IRS website, irs.gov, take a look at publication or PUB 544. If you relinquished your home in a like-kind exchange, then you should determine if you qualify to exclude gain as you would if you sold the home. Under certain circumstances, you may meet the requirements for both the exclusion of gain from the exchange of a main home and the non-recognition of gain from a like-kind exchange. For more information, see Revenue Procedures 2005-14, and you can go through and you can take a look at these revenue procedures. First place you can take a look at them or start the research would be on the IRS website, irs.gov. In this presentation, we will discuss final determination of eligibility with relation to tax consequences for selling your home. This information can be found in publication 523. Eligibility, Step 6. Final determination of eligibility. If you meet the ownership, residence, and look-back requirements, taking the exception into account, then you meet the eligibility test. Your home sale qualifies for the maximum exclusion. Skip to Worksheet 1. We'll take a look at later. If you didn't meet the eligibility test, then your home isn't eligible for the maximum exclusion, but you should continue to, does your home qualify for a partial exclusion of gain? In this presentation, we will take a look at the question of, does your home qualify for a partial exclusion of gain with relation to the tax consequences of selling your home? This information can be found in publication 523. Does your home qualify for a partial exclusion of gain? If you don't meet the eligibility test, you may still qualify for a partial exclusion of gain. So our sequence here is to see if we qualify for the full exclusion, the full 500 if married filing joint, or 200,000, 500,000, or 200,000 for the sale of the home. If we don't qualify, then we're going to take a look at and see if we could still qualify for the partial exclusion of the gain, as we are doing here. Back to the text. You can meet the requirements for a partial exclusion if the main reasons for your home sale was a change in workplace location, a health issue, or an unforeseeable event. So those are going to be our main conditions we are looking for. Let's take a look at that one more time. For reasons your home sale was a change in workplace location, health issue, or unforeseeable event. Work-related move. You meet the requirements for a partial exclusion if any of the following events occurred during your time of ownership and residence in the home. You took or were transferred to a new job in a work location at least 50 miles further from the home than your old work location. For example, your old work location was 15 miles from your home and your new work location is 65 miles from the home. You had no previous work location and you began a new job at least 50 miles from the home. Either the above is true of your spouse, co-owner of the home, or anyone else for whom the home was his or her residence. So these are going to be the conditions for the work-related move. How about the health-related move? You meet the requirements for a partial exclusion if any of the following health-related events occurred during your time of ownership and residence in the home. You moved to obtain, provide, and facilitate diagnosis, cure, mitigation, or treatment of disease, illness, or injury for yourself or a family member. You moved to obtain or provide medical or personal care for a family member suffering from a disease, illness, or injury. Family includes, so we have to be specific, of course, on what qualifies for a family member with regard to the tax code. So family in this case includes 1. Parent, grandparent, stepmother, father. 2. Child, including adopted child, eligible foster child, and stepchild, grandchild. 3. Brother, sister, stepbrother, stepsister, half-brother, half-sister. 4. Mother-in-law, father-in-law, brother-in-law, sister-in-law, son-in-law, daughter-in-law. And 5. Uncle, aunt, nephew, or niece. So fairly broad definition. A doctor recommended a change in residence for you because you were experiencing a health problem. So if it was a recommended move. The above is true of your spouse, a co-owner of the home, or anyone else for whom the home was his or her principal residence, or her residence. No principal there, her residence. How about the unforeseeable events? So now we're on the unforeseeable events. Back to the text. You meet the standard requirements if any of the following events occurred during the time you owned and lived in the home you sold. Your home was destroyed or condemned. Your home suffered a casualty loss because of natural or man-made disaster or an act of terrorism. It doesn't matter whether the loss is deductible on your tax return. You, your spouse, a co-owner of the home, or anyone else for whom the home was his or her residence. 1. Died. 2. Became divorced or legally separated. 3. Gave birth to 2 or more children from the same pregnancy. 4. Became eligible for unemployment compensation. 5. Became unable, because of a change in employment status, to pay basic living expenses for housing, including expenses for food, clothing, housing, medication, transportation, taxes, court-ordered payments, and expenses reasonably necessary for making an income. An event is determined to be an unforeseeable event in IRS publication guidance. Other facts and circumstances. Even if your situation doesn't match any of the standard requirements described above, you still may qualify for an exception. You may qualify if you can demonstrate the primary reason for sale based on facts and circumstances in work-related, health-related, or unforeseeable. Important factors are: the situation causing the sale arose during the time you owned and used your property as your residence. You sold your home not long after the situation arose. You couldn't have reasonable anticipation the situation when you bought the home. You began to experience significant financial difficulty maintaining the home. The home became significantly less suitable as a main home for you and your family for a specific reason. In this presentation, we will look at a worksheet to find your exclusion limit with relation to tax consequences for selling your home. This worksheet can be found in publication 523. Here we are on the worksheet to find your exclusion limit. We will use this worksheet only if no automatic disqualifications apply and take all exceptions into account. So we have up top A, determine if you are eligible for the maximum exclusion limit. So if we're looking at our status, we have the headers up top, status, you are eligible for the maximum exclusion, and then we're going to go through the items, which will be the ifs, items down below, maximum exclusion amounts, which will vary as we go through the status here, married, single, married filing separately, and so on. And then we have if you're not eligible for the maximum exclusion limit, then you should. What should we do next if we can't take the maximum? That's going to be the type of format of our questioning as we go through this table. So if we go through the items, we're going to say status, married filing jointly, and then we'll go through and read through this each time. You are eligible for the maximum exclusion if both spouses meet the residence and look-back requirements, and one or both spouses meet the ownership requirement. So that's basically recapping. If you've got questions about any of those requirements, of course, you can go back and take a look at each of them. So married filing joint, both spouses meet the residence and look-back test. So we got both spouse back requirements, and one or both. So now we have one or both spouses meet the ownership requirement. And then the maximum exclusion will be the $500,000 because we're talking about married filing joint, so it's going to be twice what we would think of as the single. And then if you're not eligible for the maximum exclusion limit, then what should you do? What should you do if you're not eligible? Determine if either spouse is eligible for the full limit as a single person. If not, determine if either spouse is eligible for a partial exclusion. So if we go through it and we say, okay, we can't get the full exclusion, is any one of the individuals, any one of them eligible for the single exclusion, where then we might still get possibly the single would be the 250. And if not, then we go down to the partial exclusion and see if there's any qualifications for some type of partial exclusion. That's going to be the general process for married filing jointly. What if we're single married filing or married filing separate? So these are other filing statuses, single, married filing separate. We'll go through this and read the same headers again. You are eligible for the maximum exclusion if you meet the residence, ownership, and look-back test. So this is a bit more straightforward. We have those tests there again, but we don't have this added complication where we have two people and we're trying to meet these tests, and whether or not one of them meeting the test is good enough or anything like that. There is only one person, and therefore it's fairly straightforward. The maximum exclusion then is $250,000 because it's half of what the maximum would be, $500,000 for married filing joint. And then we have if you're not eligible for the maximum exclusion limit, then you should. What should you do if you don't qualify for the maximum exclusion limit? Determine if you are eligible for partial exclusion. Obviously, we can't go back to see if our spouse is eligible for the single exclusion or anything like that. We only have the one person. If we don't qualify for the $250,000 exclusion, then our only other option is to see if we qualify then for the partial exclusion, and that's the next step that we would go to. How about the widowed status? So if we're in the widowed status, that's a bit unusual of a status. So that's going to be where there was a death of the spouse. So you can see there's going to be some unusual type of circumstances in that case. Not a normal case, not something that most people will be in when selling their home. But if it applies, then we have a bit of an unusual situation. We go to our questions. You are eligible for the maximum exclusion if 1. You sell your home within 2 years of the death of your spouse. So if we're in the widowed status, we sell the home within 2 years of the death of the spouse. 2, you haven't remarried at the time of the sale. So we're not remarried at the point in time the sale happened. 3, neither you nor your late spouse took the exclusion on another home sold less than 2 years before the date of the current home sale. So we didn't take an exclusion, or the spouse take an exclusion in the past 2 years, kind of like the look back, similar to the look back type of requirement. 4, you meet the 2-year ownership and residence requirements, including your late spouse's times of ownership and residence if need be. So we may be able to include the spouse's, the deceased spouse ownership test in order to meet this item in number 4. If that's the case, the maximum exclusion then is $500,000, which is great because you would think if you were widowed, you'd be more of just a single individual, and you might be thinking you'd be limited to the 250, but they're saying it's 500. if you meet those conditions. What if you don't? Then we go to, if you're not eligible for the maximum exclusion limit, then you should determine if you are eligible for the full limit as a single person. So same as the item 1, we're going to say, oh, well, if I don't get the 500 exclusion, do I qualify for the 250 exclusion? If not, then determine if you are eligible for the partial exclusion. So that's how we'll go through our thought process when thinking through the exclusion limits. And then part B says, complete this section only if you have determined that you aren't eligible for the maximum exclusion, but are eligible for a partial exclusion. If you are eligible for a partial exclusion, use this section to determine your exclusion limit. So note, if we're taking the maximum exclusion, then it is what it is. We have the maximum exclusion. Hopefully, for most cases, it's fairly cut and dry. We qualify for the maximum exclusion, and or we don't, and it's pretty straightforward. If not, then, however, then we go into the partial exclusion, which is a bit more complicated to determine. The steps involved here are listed out in the table. Step 1, determine the shortest of the following 3 periods. 1, your time of residence in the home during the 5-year period leading up to the sale. Or 2, your time of ownership of the home leading up to the sale. 3, the time that has elapsed between the sale and the date you last sold a home for which you took the exclusion. That's going to be in part 1. Step 2, take the smallest period from step 1. You may use days or months and divide that number by 730 if using days or 24 if using months. So we could break this information out into whatever increment would be most sufficient to do, either using the days, 360 up to 365 days, or we can break it out into months time period, and then we're going to basically use our ratio. So take the smallest period in step 1, the smallest period we have up top, which is measured in either days or months, and divide that number by 730 if we're using days, 730 of course being the 2-year time period, which would be 365 times 2, which is the 730, or of course 12 months times 2. So it's basically the 2-year time period. And then step 3, multiply the result from step 2 by the 250,000. So the 250,000, which is basically the maximum exemption for the single or non-marriage status typically. Stop here if not married, filing jointly. And then step 4, repeat steps 1 through 3 for the spouse and add the 2 results. So we're going to, if we're not married, we'll stop here. If not, then we go to step 4 and then see your exclusion limit is that amount of dollar amount. Unless you have taxable gain from the business or rental use, see business or rental use of home. Only gain is in excess of this amount is taxable. So we're figuring out, of course, the exclusion. So the exclusion is what is not going to be taxable. So we would need gain above this amount that would then be taxable. So in other words, we are, of course, if this was our exclusion, these would be the maximum exclusions. We would need a gain above those exclusions before they were taxable. If we then figure some lower exclusion, whatever that exclusion is, then the gain would need to be above that exclusion, and that would be the portion that would be then taxable. In this presentation, we will discuss how to figure the gain or loss for the sale of a home for tax purposes. This information can be found in Publication 523. Figuring gain or loss. To figure the gain or loss on the sale of your main home, you must know the selling price, the amount realized, and the adjusted basis. Subtract the adjusted basis from the amount realized to get your gain or loss. In prior presentations, we took a look at an example problem which did calculate the amount realized and the adjusted basis and subtracted those two out to get to our gain on sale. So you might want to refer back to that as we go through the components here. We also know that there's a worksheet in the Publication 523, which will go through a similar type of calculation, more of a long kind of format. We also provide an Excel worksheet that you can use as reference to that as well. In prior presentations, we also put that information into the 1040, so you can see how it all applies out to the 1040 on Schedule D. So you're going to see Schedule D will be the sale form for capital gains for the sale of the home. Back to the text. Certain events during your ownership, such as use of your home for business purposes or for making improvements to it, can affect your gain or loss. they are explained in this section. So if we have any kind of adjustments, especially if we depreciated or got some benefit from depreciation of the home in some way, for example, if we used it as in our business or as rental property, then we may have to adjust. See Worksheet 2 later for steps you should follow to figure your gain or loss. So as we go through this, you can look at Worksheet 2 in Publication 523. You can use this worksheet as well and look through the components that is provided in the Excel worksheet. This is just a simulation or approximation of that worksheet as well. Back to the text. Basis adjustments. Details and exceptions. You should include many, but not all, costs associated with the purchase and maintenance of your home in the basis of your home. So when we consider the basis, remember we're talking about, in essence, the cost. So when we consider our formula, we have the amount realized, basically the sales price, and then the cost, which is basically adjusted. We use the term basis because basis is a little bit broader. We'll include those adjustments when we consider what the basis is. For more information on determining basis, you can see Publication 551, Basis of Asset. You can go to the IRS website, irs.gov, type in pub or publication 551. Fees and closing costs. Some settlement fees and closing costs you can include in your basis are abstract fees, abstract of title fees, charges for installing utility services, legal fees, including fees for the title search and preparing the sales contract and deed, recording fees, survey fees, transfer and stamp taxes, and owner's title insurance. Some settlement fees and closing costs you can't include in your basis, and these are the ones that you cannot include in the basis. Those are fire insurance premiums, rent for occupancy of the house before closing, charges for utilities or other services related to occupancy of the house before closing, any fee or cost that you deducted as a moving expense allowed for certain fees and costs before 1994, changes connected with getting a mortgage loan, such as 1. Mortgage insurance premiums, including funding fees connected with loans guaranteed by the Department of Veterans Affairs, and 2. Loan assumption fees, 3. Costs of a credit report, 4. Fee for an appraised required by a lender, an appraisal required by a lender, fees for refinancing a mortgage. Construction. If you contracted to have your house built on the land you owned, your basis is, so now we're talking about the construction. So if we had the piece of land and then we constructed the home, then we might consider, well, what would our basis be in that case? We would then have the cost of the land. So obviously when we purchased the land that we put the home on, we would have purchased that, and that would be part of the cost. In addition, we're of course going to build on that land, and that's going to be part of the cost of the home as well. So we will include the amount it costs you to complete the house, including 1. The cost of labor and materials, 2. Any amounts paid to a contractor, 3. Any architect's fees, 4. Building permit charges, 5. Utility meter and connection charges, and 6. Legal fees directly connected with building the house. So if we had to construct the house, or if we went through the process of constructing the house, the cost that would typically be assigned to the building, the raising of the home, as well as the cost of the land that we put the home on, you would typically think would be part of the basis calculation. For more details, if you're in that situation, then you might have a lot of items that you would be questionable as to whether they're part of the construction or possibly just normal repairs or not included within the home. So you want to look into more details in that situation so you have specific questions about specific items. Back to the text. Your costs include your down payment and any debt such as a first or second mortgage or notes you gave the seller or builder. It also includes certain settlement or closing costs. In addition, generally you must reduce your basis by points the seller paid you. If you built all or part of your house yourself, its basis is the total amount it cost you to complete it. Don't include the cost of the house, the value of your own labor, or the value of any other labor for which you didn't pay. Notice the IRS is skeptical of any kind of unpaid labor, possibly because it's not going to have a good audit trail. It's pretty difficult to track or trace what the value of the unpaid labor would be. Back to the text, costs owed by the seller that you paid. You can include in your basis any amounts the seller owes that you agree to pay, as long as the seller doesn't reimburse you, such as any real estate taxes owed up through the day before the sale date, back interest owed by the seller's title, recording, or mortgage fees, charges for improvements or repairs that are the seller's responsibility, for example, lead paint removal, and sales commissions, for example, payment to the seller's real estate agent. In this presentation, we will discuss improvements as they relate to tax consequences for selling your home. This information can be found in publication 523. As we discuss improvements, note where they lie on our formula. So when we think about the gain, we have the sales price, and then we have the amount realized, which in essence is the adjusted sales price. And then we have the cost or basis, which includes what we purchased it for and improvements. So in other words, the improvements could increase the basis, or what we could think of as the cost, or the adjusted cost, the basis. And an increase in basis will decrease the amount of gain. A decrease to the amount of gain could result in less taxes. So in other words, we want to categorize things as improvements if we can, usually when considering the sale of home or real estate, because that will make the gain lower, which could result in less taxes. So just keep that in mind. That's the perspective we have. And then the question is, well, what qualifies for improvements? That is what we will discuss now. Back to the text. Improvements. Improvements add to the value of your home, prolonging its useful life, or adapt it to new uses. So those are going to be key types of terminology you want to keep in mind when considering improvements. In other words, it prolongs the life as opposed to simply bringing the life of the home up to where it should be, like a repair. A repair just brings it back to its essence, or where it should be. The prolonging of the life would be bringing it out into the future. It's going to make it last for a longer period of time. So it's usually considered a larger thing. So in many types of items, you might consider, well, is this just a normal repair that brings it back to its normal operations, or is it some type of improvement? And if you think about something like a roof, if you just patched the roof or something like that, that would probably be simply just a repair because you just patched it, as opposed to if you put a whole new roof on, that could extend the life, and that would be an improvement. If you alter or adopt the use, then that's another type of improvement as well. So in other words, we changed the functionality of it in some way, and therefore that could be considered an improvement as well. Back to the text. You add the cost of additions and improvements to the basis of your property. The following chart lists some examples of improvements. So here's going to go through some common examples of what improvements would be. So we have additions. So if we had some type of addition, like an added bedroom, bathroom, deck, garage, porch, patio, if we actually built onto the home, then that would pretty clearly be an improvement because we actually added to the home. We've made it more than it was before. If we have lawn and grounds, what about the gardening, or what about the groundwork? Well, if we had major landscaping, if we put the driveway in, a walkway, a fence, a retaining wall, a swimming pool, those are all within the grounds, not exactly on the building, still leasehold or still improvements, items that could increase the basis. So again, those are things we want to track, we want to record them, we want to make sure we have records of them so that we can include them in our improvements for the home sale when needed. So then we have the systems, a heating system, a central air conditioning, a furnace, ductwork, central humidifier, central vacuum, air water filtration system, wiring, security system, lawn sprinkler system. So any of those types of items, if you think back in their home sale and you're saying, I had a major kind of system item that needed improvements and that cost a lot of money, that could possibly be increasing the basis, and therefore by being an improvement, and thereby lowering the cost of a sale possibly. So then we have the exterior. If we have the storm windows or doors, we have a new roof, we have the new siding, and we have the satellite dish. These could be items that could add to the value for the exterior. Insulation, if we added insulation in the attic, walls, floor, pipes, and ductwork, again, those extending or changing the life could be something that we can add as improvements. Plumbing, septic system, water heater, soft water system, filtration system, all items that could be adding to the value. Interior, built-in appliances, kitchen modernization, flooring, wall-to-wall carpeting, and fireplace. So these are all items, if you think back and you're selling the home and you're like, we had one of these items or we had some of these items that were major overhaul type of improvements, then you want to consider whether you want to make sure you have the documentation and put that together, and that might be something that you can include as an improvement, which could lower the cost. Note again, at some of these things you might look at it and say, well, we didn't replace the roof entirely, but we fixed a large portion of the roof or something like that. And you could have a lot of areas where you say, that's kind of a gray area. And note that if it's a maintenance thing, if it's a repair and you just repaired something, that may not be considered an improvement. And if you improved it or extended the life or replaced something, more likely to be improvement. So just keep that in mind as you go through and think about the improvements. Back to the text. Repairs done as part of large project. You can include repair type work if it is done as part of an extensive remodeling or restoration job. So notice repair work is not something that you would typically include. If you had some little repair work, you repaired some part of the home, typically that would just be a repair, not included as an improvement, not extending the life. However, there could be an exception if the repair work is part of a large project. If as of part of the large overhaul project, you included repair work, then that repair work, which may have been, if it was on its own, just be a repair, not something that can help us out in terms of increase in the basis, might be applicable as part of an overhaul of a large type of job. Back to the text. For example, replacing broken window panes is a repair, but replacing the same window as part of a project of replacing all the windows in your home counts as improvement. So, if a ball went through one window and you called the window person, you said, I have to fix this one window because a ball went through it, probably not, it's not an improvement. In that case, you just fixed one window. But if you were going to do all the windows, say you want to insulate and have better insulated windows and have these fancy windows that are going to keep sound in or out and air in and out and whatnot, then that could be an improvement because that's going to be a major job to the whole home. Back to the text. Example of improvements you can't include in your basis. So these are things that you cannot include. You cannot include any costs of repair or maintenance that are necessary to keep your home in good condition but don't add to its value or prolong its life. Examples include painting, interior or exterior, fixing leaks, filling holes or cracks, or replacing broken hardware. Any costs of any improvements that are no longer part of your home, for example, wall-to-wall carpeting that you installed but later replaced. Any costs of any improvements with a life expectancy when installed of less than 1 year. So if it's something that you're going to put in place and it's only planning on lasting a year, then that doesn't seem like it's going to be a long-term type of thing. That seems like a short-term, possibly more of a repair type thing. Back to the text. Exception. The entire job is considered an improvement if items that would otherwise be considered repairs are done as part of an extensive remodeling or restoration of your home. For example, if you have a casualty and your home is damaged, increase your basis by the amount you spent on repairs that restore the property to its pre-casualty condition. Energy credits and subsidies. So we have these energy credits and subsidies. How do they play in to the improvements? Back to the text. If you included in your basis the cost of any energy-related improvements, such as a solar energy system, and you received any tax credit or subsidies related to these improvements, you must subtract those credits or subsidies from your total basis. So you'll note that if we have these energy type items, then they're going to be things that could qualify for improvements because they're going to extend the life. However, we've already got a tax benefit in the year that they were put in place, possibly with regard to credits, which are a dollar for dollar tax back at the point of time we put the improvement in place. So part of the reason we might have put the improvement in place is because we knew we were going to get a tax credit, possibly. In any case, if we got a tax credit, then we're gonna include the cost of it, but we're gonna have to take out generally the amount of tax benefit we already received for it, which would be the credit possibly that we got in the past. So in 1977 through 1987, credit for home energy improvements was there. So if we had her improvement there, we might have got a credit, and we'd have to take a look at that and maybe adjust for that. In 1992 to the present, direct and indirect subsidy for a public utility for installation or modification aimed at lowering a home's electricity or natural gas usage or better management its energy demand. In 2006 to now to present, we have a credit for home energy efficiency improvements. From 2006 to the present, we have a credit for qualified solar electric property expenditures and qualified solar water heating property expenditures available. And in 2006 through 2007 and 2009 through 2017, we had a credit for energy improvements on non-business property. In this presentation, we will discuss home acquired through a trade with relation to the tax consequences for selling your home. This information can be found in Publication 523. Home acquired through a trade. Traded for another home. When you trade your home for a new one, you are treated as having sold your home and purchased a new one. Your sale price is the trade-in value you received for your home plus any mortgage or other debt that the person taking your home as a trade-in assumed took over from you as part of the deal. Traded for other property. If you paid for your home by trading other property for it, the starting basis of your home is usually the fair market value of the property you traded. So if we have these kind of considerations where we had a trade for the home, in this case, if we have the trade for the property, we would have to consider the basis because we need to know what the cost is as the value of the fair market value of the property we traded for. You can see how that would be a little bit complex possibly because the item that we traded for may be somewhat unique in nature, as real estate is unique in nature and other items could be somewhat unique. We don't know exactly what the price is, but the theory of it would be that if we had two people that were negotiating together in a fair market, a free market, then they would trade something of similar or equal value. And therefore, when we trade our property, or if property was traded, then, or real estate property was traded, then it must have been traded, in theory, on a free market with two people that aren't related for something of equal value. In this presentation, we will take a look at scenarios or situations related to a home destroyed, condemned, or received in divorce with relation to tax consequences for selling your home. This information can be found in Publication 523. You have a disposition when your home is destroyed or condemned and you receive other property or money in payment, such as insurance or condemnation award. This is treated as a sale and you may be able to exclude all or part of any gain that you have. If your home was destroyed, see Publication 547. If your home was condemned, see Publication 554. You can go to 544. You can go to the irs.gov website and then type in publication or pub 547 or 544 in those conditions. Obviously, this would be more of an unusual type of condition, but you can see the IRS's kind of standpoint here, what would typically be what we would assume to be the case. If the home was destroyed or condemned and we got some type of payment for it, possibly something like insurance, then we might think of that kind of like a sales type transaction that happened, in that we got some type of format of payment and the home is now gone, right? So how would we deal with that type of situation? Would be a special type of situation. For more information on it, you could take a look at those publications. Home received in divorce. Home acquired after July 18th, 1984. If your former spouse was the sole owner, your starting basis is the same as your former spouse's adjusted basis just before you received the home. If you co-owned the home with your spouse, add the adjusted basis of your spouse's half share in the home to the adjusted basis of your own half share to get your starting basis. In most cases, the adjusted basis of the two half shares will be the same. The rules apply whether or not you received anything in exchange for the home. If we consider a home that was received in a divorce settlement, we could see a few different types of scenarios. For example, we can think of a scenario where the home was there, one of the spouses owned the home before the marriage took place, in which case you have the question, well, what is the basis in that format? And then you have the other format where it might be that the two were married and then purchased a home. So then, of course, the home was then purchased during the married point in time as they were joint at that point in time. And then in the divorce settlement, the home might go to one or the other, whatever the divorce settlement might be. So you can take a look at those different types of scenarios. Again, our goal here is to find what that basis should be, what's going to be the cost of the home, so that when we figure our calculation, we're considering the cost of the home, and we really want it to be as high as possible, right? We want to know what the cost is, which will be part of the basis, and we want the basis so that we can have the sales price minus the basis, giving us the gain or loss, and we want the gain to be as small as possible to reduce the amount of taxes that could be owed. Back to the text. Home acquired on or before July 18th, 1984. Your starting basis will usually be the home's fair market value at the time you acquired it from your spouse or ex-spouse. For more information here, you can see publication 504, Divorce or Separated Individuals. If you or your spouse or co-spouse lived in a community property state, you can see publication 555, Community Property. And notice again, if you're looking into more detail on this, if this is a situation that applies, you want to do more research onto those, to the rules with relation to the divorce and the basis for divorce and the basis specific to specific states that might have different rules with relation to community property. In this presentation, we will discuss situations where a home is received as a gift or a home is inherited with relation to the tax consequences of selling the home. This information can be found in publication 523. So when we consider our formula and think about, well, what's going to be the cost of the home as we sell it, because of course we need the sales price or the amount realized, basically the amount we sold it for, and then we need the cost and the adjusted cost or adjusted basis to subtract those two out. We would like the basis to be higher because the higher the basis is, the lower the gain. The lower the gain, the less taxes. We might have a question. We could say, well, I don't know what the cost is because I inherited it or someone gave me the house. In that case, I don't know what the basis is because I didn't buy it myself. Well, what's going to be the basis in those cases? What's the basis to me if I inherited the property, or what's the basis to me as I sell the property if the property was gifted to me? Those are going to be the questions here. Back to the text. Home received as a gift. If you received your home as a gift, you should keep records of the date you received it. Record the adjusted basis of the donor at the time of the gift and the fair market value of the home at the time of the gift. Also, ask if the donor paid any gift tax. As a general rule, you will use the donor's adjusted basis at the time of the gift as your basis. So that's going to be the general rule. So if it's a gift, then we're going to typically be using the adjusted basis at the time of the gift. So the adjusted basis at the time of the gift. So we would basically calculate this item then, the cost. We're thinking about the basis, and we're considering what the adjusted basis would be for the person who gave it to us, the donor's adjusted basis. Back to the text. However, see Table 2 below to determine if any exceptions to this rule listed in the if column apply. Now note, when you consider a gift of something like a house, you would consider it would probably be a fairly large amount, and that's why you'd get into things like gift taxes and those types of situations. But again, general rule here, the general rule in the gift situation is your basis would be the adjusted basis at the time of the gift as your basis, the donor's basis, in other words, to the table. Exceptions to using a donor's adjusted basis for a home received as a gift. So we have our if and then type table. So we have if and then. So we'll go through this, see how this works out. Reading the first item, at the time of the gift, the donor's adjusted basis in the home was more than the home's fair market value. So the adjusted basis is more than the fair market value. And that doesn't typically happen. We would hope that the home went up in value. Real estate, we're hoping, goes up in value, and we would think the fair market value would be more than the basis. But in the situation where the basis is more than the fair market value and your usage of the donor's adjusted basis as your basis results in a loss, then you must use the fair market value of the home at the time of the gift as your basis. If using the fair market value results in a gain for you, then you don't need to recognize that gain. So in that case, we're not in that special kind of situation where the fair market value would be less than the basis, and the usage of the donor's adjusted basis as your basis results in a loss. Notice that the IRS is skeptical of losses, right? Because if you have a loss, then it's possible maybe that you could take a loss against other income. And so the IRS is skeptical of losses. So what do? They say, well, there's going to be a loss. We need to stop this somehow. So then you must use the fair market value of the home. That will be less likely to result in a loss. So you must use the fair market value of the home at the time of the gift as your basis. And then they give you a kind of consolation. You're going to say, well, what if that gives me a gain then? Then I have to pay on the gain. Well, they're going to say, well, we just really wanted to eliminate the loss is what they're saying here. So then they're going to say, if using the fair market value results in a gain for you, then you don't need to recognize that gain. So they're basically going to say, hey, we didn't want the loss to happen. So if this results in a loss, we're going to not make you do that by forcing you to use the fair market value in that strange situation. But if the fair market value results in a gain, then you don't need to recognize the gain. And that's good because you wouldn't have to pay taxes in that kind of strange situation. Next one, if at the time the donor's gift, the donor's adjusted basis in the home was less than the home's fair market value, and the donor paid gift tax on the gift of the home, so now we have this gift tax involved, then you figure your basis by starting with the donor's adjusted basis at the time of the gift and adding the federal gift tax paid due to the increase in value of the home. And so if that's going to be a situation, you want to see regulations section 1.1015-5 for further details. Again, kind of an unusual type of situation, gifted and there was gift taxes that were paid. If that's something that applies to you, then you want to go and looking at further information on it. This is the regulations to take a look at that. Back to the text. Home inherited. So then you might say, well, what if I inherited the home? That might be actually more common of a situation to inherit the home. You're going to say, well, I don't have the basis, I don't have the cost, I don't know what was paid for it because I inherited it. What happens in that situation? Back to the text. Home acquired from a decedent who died before or after 2010. So notice that covers a lot of territory, died before or after, which means that 2010 is kind of a strange year. So before or after 2010, back to the text. If you inherited your home from a decedent who died before or after 2010, your basis is the fair market value of the property on the date of the decedent's death. So that's going to be the typical rule. Notice that the gift and the inheritance are kind of related because you would think that the gift might be going to someone that would inherit the property and at the point of death. So notice there's some relation if you look into gift taxes and inheritance taxes and things like tax planning and whatnot, then you might think there's going to be some relationship, of course, because the question would be, should you gift the property or something like that before death, or should you let it pass at the point of death? Is there a better point in time? And so you can see how those two things are basically could be thought of to be related. So in the case of an inheritance here, your basis is the fair market value of the property on the date of the decedent's death. So note that's going to be a little bit different there than the general rule on the gift, Whereas now we're saying that the basis in the property will typically be the property's fair market value at the point of death. How would we know what that would be? Well, we'd have to use an appraisal or something like that because there was no sale that happened at the point of death. But notice that difference, and one reason that difference might be there is because of things like an estate tax. If there was an estate tax, meaning if the person died, sometimes it's called a death tax. So if the person died, then the estate, they pile up all the money and the government takes their share and then they give the rest out. If that happens, then they already kind of pay taxes on the estate tax. So then you would think the code would at least give you a benefit as a step up in basis, meaning the basis in the property, the cost in the property probably went up over time, hopefully, than from the time that it was purchased by the deceased individual. So in that case, then you might get a step up in basis. The basis might be higher than it would have been if you just had in a gift situation, possibly, where you would just have to assume the basis of the person who gave it. And that would usually be worse because you would think that they would have bought it back in time when time value of money was less and whatnot. Hopefully the property went up in value. So back to the text. There's a kind of a big difference there between the gift and the inheritance in some ways. Back to the text. Or the later alternate valuation date chosen by the personal representative of the estate. If an estate tax return was filed or required to be filed, the value of the property listed on the estate tax return is your basis. So the estate tax return, you could think of basically taking all the value of the property of the decedent's property and listing it, and now it's all valued out on the estate tax return. And so that would typically be what you could use as the adjusted basis. Now, they may not have been required to have an estate tax return, in which case you typically still could get the benefit of the step up in basis, even though there wasn't an estate tax or like a death type tax, and so that you could still have that benefit. But in that case, without the tax return, then you'd have to figure out what the basis was at the time of death, and so you'd have to use some type of appraisal to do that. Back to the text. If a federal estate tax return didn't have to be filed, your basis in the home is the same as its appraised value at the date of death for purposes of state inheritance or transmission taxes. Surviving spouse. If you are a surviving spouse and you owned your home jointly, your basis in the home will change. The new basis for the interest your spouse owned will be its fair market value on the date of death or alternate valuation date. The basis in your interest will remain the same. Your new basis in the home is the total of these two amounts. Note that this could be a good thing. This kind of should be a good thing, because if you think about it, then the cost, you're talking about the cost, we want the cost to be as high as possible, and usually the homes go up in value over time. So if you lived in a home for a long time, just the time value of money, you would think that the cost of the house would go up. So, and if you own the property kind of jointly, if you think about it as both your property, if you bought it and you're married and you think about it as both your property, and one person dies, then you kind of think about it, well, it should be the case that you, in essence, kind of like inherited it, right? You're the surviving spouse. Now it's yours, but you should get that step up in basis is what we're looking for to happen. So it would be nice then if whatever the purchase price was, if the deceased individual could allow for that step up in basis to the fair market value at the point in time of death for their half of the home, so that when you sell the home, then the cost could be stepped up from the purchase price way back when to the purchase price up to at least half of it, the amount that we would apply to the one spouse that died, being up to the fair market value at the point in time of death, and that could result in a higher cost, a higher basis, resulting in lower gain, resulting in lower taxes. Back to the text. If you and your spouse own the home either as tenants by the entirety or as joint tenants with right of survivorship, you will each be considered to have owned one half of the home. So be careful when you start to consider the types of ownership when you consider the point of death. If there's dual people owning it, whether it be in a marriage or some other type of contractual situation where multiple people own it, then you want to consider what's going to happen at, the point of death of one of those individuals. And some of these things with relation to marriage as well could change basically from state to state as they consider the type of property in marriage from state to state. Let's take a look at an example. Your jointly owned home, owned as joint tenants with right of survivorship, had an unadjusted basis of $50,000 on the date of your spouse's death, and the fair market value on that date was $100,000. Your new basis in the home is $75,000. $25,000 up for one half of the adjusted basis plus $50,000 for one half of the fair market value. So if you see how that makes sense, we bought it, if we purchased it for $50,000 and there's two individuals involved, one of the individuals died, the other one is assuming, well, what's going to be the basis to the other individual? Well, if at the point of death the property was worth $100,000, it would be nice to get some type of step up in basis. And basically you would have the step up in basis not to the 100, but to 75 in this example. Why? Because we have the $25,000, which would be the surviving spouse half of the 50, the purchase price, the original basis, for one half of the adjusted basis plus 50, or one half of the fair market value. In other words, the half that we're basically attributing to the spouse that deceased got a step up in basis to the 100,000, their half being 50,000 of that. So that would mean that the full piece of property, then half of it, the surviving spouse's half, has a basis of the lower basis, 25, and the spouse that died got the step up in basis to their half being at the 50,000 for a total of the 75,000 for the basis. Community property. In community property states, including Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin, each spouse is usually considered to own half of the community property. When either spouse dies, the total fair market value of the community property becomes the basis of the entire property, including the part belonging to the surviving spouse. For this rule to apply, at least half the value of the community property interest must be included in the decedent's gross estate, whether or not the estate must file a return. So just keep in mind, as we consider something like the sale of the home, or as we consider the basis in the home for future sale at some point, or planning for things such as death, we need to have an idea of how the ownership of the property is owned, if it's owned by more than one individual, and we want to make sure we understand the rules and for ownership for some type of joint property or property owned by more than one individual in the case of marriage, which could change from state to state. If you're in one of these states, then you're talking about community property states. You want to make sure that you're looking at the rules and regulations with relation to community property, and that's something that you can research more on. For more information here, you can take a look at publication 555. Go to the IRS website, irs.gov, type in publication or PUB 555. In this presentation, we will take a look at business or rental use of your home as it relates to the tax consequences of selling your home. This information can be found in publication 523. Business or rental use of home. This section applies only if you used a portion of your home for business or rental purposes during your ownership. So in other words, if we're selling the home and we had the home used for business or rental purposes, then some consequences, there might be some tax consequences we have to take into consideration when considering the sales price and possibly paying any taxes related to the sale of the home. If we didn't have any business or rental use within the home, if we just in essence lived in the home, then we don't have to look at this part. This won't apply. Back to the text. This type of usage may affect your gain or loss calculations. For more information about using any part of your home for business or rental property, see publication 587, Business Use of Your Home, and publication 527, Residential Rental Property. You can go to the IRS website at irs.gov, irs.gov, type in pub or publication 587 or 527, whichever is applicable to you. Exceptions. The following situations of business or rental use don't affect your gain or loss calculation. Space within the living area. If the space you used for business or rental purposes was within the living area of the home, then your usage doesn't affect your gain or loss calculation. Example of spaces within the living area include rented space, bedroom, and attic space used as a home office. In contrast, business or rental spaces not within the living area affect your gain-loss calculations. Examples of space not within the living area include a first-floor storefront with an attached residence, a rented apartment in a duplex, or a working farm with a farmhouse on the property. Space formerly used for business or rental. And note, as we go through these items, one of the major things that is going to be affecting whether the gain or loss is whether or not depreciation was taken in the business use of the property, because we're talking about the basis calculation. So as we think about these things, we're typically considering this side of the equation. So we have the sales side, then we have the basis or cost side. The cost, if it was a business use, say it wasn't a home, if it was business property, we would depreciate or allocate that cost over the life of the property. Now, because it's personal, we don't do that. We don't allocate the cost over the price, so we're not getting any tax benefit for the depreciation or the allocation of the cost because it's a personal house that we used. But if we rented it in some ways, then we might have, this is one of the things that could happen, a situation where we're allocating the depreciation, and by doing so, we're basically lowering the basis. We're kind of getting the tax benefit of the basis. So that's one thing that could affect when we use the home, not as solely personal use, but as some form of business use. That depreciation could be a factor that could be one of the things that adjust the basis calculation. So again, if we have no business use, that's not the case because it's all personal, and we didn't get any benefit from the lowering or the allocation of the cost of the property. The other huge component is, of course, the exemption. So if we have the business use of the property rather than the personal home use of the property, the question is whether or not we get the exemption related to it as we make the sale of most likely a business portion of the property and the personal home, or in other words, we have the personal home and some portion that may be business related. What happens with this exemption? What happens to the cost or basis with relation to the fact that we had depreciation? Okay, back to the text. Space formerly used for business or rental. Space that was once used for business or rental purposes may be considered as resident space at the time of sale. A space formerly used for business is considered residence space if all the following are true. You weren't using the space for business or rental at the time you sold the property. You didn't earn any business or rental income from the space in the year you sold your home, and you used the space as a residence space for 2 years out of the 5 years leading up to the sale. So what we're trying to get to is if we have a space of property that we used to have, and it used to be basically rental property and now it's personal property, we want to have those rules basically qualify for personal property as part of the home sale, because that will probably be most beneficial, most advantageous, and possibly allow us to have an exemption related to it. Back to the text. And your space is considered as resident space at the time of the sale, then your former business usage doesn't affect your gain-loss calculation. Business or rental usage calculation. If you have used part of the home, not within the home's living area, for solely business or rental purposes for more than 2 of the last 5 years, you need to make separate gain-loss calculations for the business and residence portion of your property. So in this case, we have a separate kind of portion of our property, which we have to say is business because it's not part of our living area, and the other part is going to be our actual personal. And if that's the case, then the part that's business, we have to calculate the gain or loss separately. We might sell it all together, but we're still thinking of selling, in essence, 2 separate things. One, a personal residence home. The other is going to be kind of our business activity or our business portion of the property. And we're going to have to make some type of allocation in certain conditions between those two. And of course, our goal, what we would like to have happen, if possible, if we fall into the regulations, to have more of it as personal, as residents, as part of our home, because there's probably going to be tax advantages to that, including possibly qualifying for the exemption. Back to the text. Make 3 copies of all pages of Worksheet 2. Label 1 copy total, 1 copy home, 1 copy business or rental. So they're recommending look at Worksheet 2, and so this is a copy in Excel, and make 3 copies of them, they're saying, which is in essence, yeah, you could add like 2 more columns to a worksheet such as this, and then break out the total versus the business and the rental calculations. So you can see the thing in total, and then you can see it broken out between the 2 portions of the home, which will be rental and the personal property. Back to the text. Complete your total worksheet using the figures for the property as a whole. So that we're going to have the whole entire property as if it was one. And then back to the text, include the total amount you received, all of your basis adjustments, etc. Include cost of all improvements, whether you made them to the business space or the residential. So obviously we're thinking of it in the total column first, calculating as if it was all together. And then of course we're going to be breaking them out between the 2 segments, the business versus the non-business or personal. Back to the text. Determine your business or rental percentage, meaning the percentage of your property that you used for business or rental. If you took depreciation on your home on past tax returns, use the same business or rental percentage that you used in determining how much depreciation to take. If you didn't take depreciation on your home on past tax returns, compare the size of your business or rental space to the size of the whole property and express this as a percentage. For example, if you have a building with 3 equal size stories and you live in the top 2 stories and use the ground floor for a store, then you are using 1/3 of the property and your business percentage is 33.3%. So the strategy here is looking at the total. We have this worksheet in total and then breaking them out between the business and personal portion. Now, if we had to record depreciation in the past, which we may have had to do if we were using it as rental property or some type of business property, we have probably already done some type of allocation so that we can apply that depreciation out, and we probably use some type of ratio to do that, so we can use that same type of allocation. If not, if we didn't apply depreciation, meaning for example, in this example, we had the bottom floors being a store. If we had the store and we, for some reason, didn't apply the depreciation to the store, we didn't take advantage of, the depreciation. In other words, we didn't allocate part of the cost to the store, then we're going to have to figure out what that depreciation amount would be, and we can use some type of reasonable method, which could be some type of comparison or ratio of the total units or the total square footage compared to the square footage or something like that used for business purposes. Back to the text. For each number on the total worksheet, figure the business-related portion of that number and enter it on your business or rental worksheet. You may use different methods to determine the business portion of different numbers. Here are the 3 possible methods and the circumstances under which each method applies. Dollar amount method, where a figure consists of specific dollar amounts that relate to either the residence portion or the business portion of the property. The figure must be broken down by these dollar amounts. For example, if the figure for improvements to the property was $100,000 and all of that applied to the residence portion, then the business portion of the improvements would be 0. So note, when we think about this, if we think about the total column here, and we're then trying to break out things like improvements between the business portion and the personal portion. Well, obviously, if the improvements were to the whole property, then we could use some type of percentage, or we got to figure something out. But if we just made improvements to the personal property, so if in this case, in our case, just to the top floors and the bottom business floor, there was no improvement because we were working on the personal property, then obviously we don't break out using any percentage. We apply the entire amount to where it goes, which in that case would be the improvements of the personal property. Back to the text, 100% for depreciation. The first 2 items underlined 5A and 5B in Worksheet 2 are business depreciation items. Any figure for these two items is 100% of business figure. So when we think about depreciation, notice depreciation doesn't have anything to do with the personal typically, because we don't depreciate the personal property. So if there's any depreciation figures on there, and that's one of the major things we're considering here, because that's one of the major reasons the IRS would want to break out the business and personal, because once again, we're going to be taking advantage of the depreciation, meaning we already got a benefit of applying out possibly in the past some of the depreciation. So if we go down to our worksheet to line I, where it says determine your basis adjustments, any payments, credits, or benefits you may need to deduct from, and then A says any depreciation you took or were allowed to take for use of your home for business or rental purposes. So that, of course, means it would only apply if we were using part of the home for business or rental. And then B says any casualty losses such as flood or fire damage you claimed as a deduction on the federal return. Let's go back to the text. Percentage method, where a figure applies to the property as a whole, such as the sale price, the business or rental portion is the figure multiplied by the business portion percent you described earlier. Use the percentage method for all items that don't require the dollar amount or depreciation methods. So in other words, like the sales price, if we talk about the sales price up top, well, the sales price is going to be, if we had the situation where we had the residential on top of the top stories and the business on the bottom story, when we sell it, we're going to sell it all at once. It's going to have one sales price. So we can't break out, how are we going to break out that sales price? The price was paid for all of it. And that's when we're going to have to use some type of percentage method typically. We'll use some kind of percentage method to break out like a square footage of the business versus the total, the personal versus the total, something like that would be reasonable to break out between the personal and the business. Back to the text. The total you get on line 7 on your business copy of Worksheet 2 is the gain or loss related to the business or rental portion of the property you sold. Next, complete your home worksheet. For each number, take a number from your total worksheet, subtract the number from your business or rental worksheet, and enter the result in your home worksheet. For example, subtract the number on line 1F of the business or rental worksheet from the number on line 1F of the total worksheet, and enter the result on your home worksheet. So the suggestion here is to start with the total worksheet and then break out the business portion. And then if you subtract the two out, you'll get to your personal worksheet. And then if you work the other way, of course, the personal plus the business worksheet should equal the total worksheet. So we're going to have, in this case, you can do a worksheet like this and just have 3 columns. But it's suggested to start with the total column first, because that's going to be easier in that it'll be all combined together. And then go through them and figure out how you're going to figure out the breakout between the business and the personal. And of course, the business plus the personal should add up to the total column. Back to the text. Now figure the totals on your home worksheet. The total you get on line 7 on the home copy of Worksheet 2 is the gain or loss related to the home portion of the property you sold. Review the results of your home and business worksheet to determine your next step. When you have completed each worksheet, you will know whether you have a gain or loss on each part of your property. It is possible to have a gain or loss. It is possible to have a gain on both parts, a loss on both parts, or a gain on one part and loss on the other. See Table 1 to determine your next step. So here we have Table 1. We've got the if-then type of worksheet. So Table 1, if your home or business shows a gain or loss. So if your home worksheet shows a loss, then follow the instructions at the end of line 7 under Worksheet 2 for if number is negative. And then if your home worksheet shows a gain, then skip to how much is taxable and Worksheet 3 to find out how much of the gain on your home worksheet is taxable. And then if your business worksheet shows a loss, then don't follow the instructions at the end of line 7 under Worksheet 2. Instead, report the loss from your business worksheet on Form 4797, Sale of Business Property. And if your business worksheet shows a gain, then you don't exclude any of the gain shown on your business worksheet. Don't follow the instructions at the end of line 7 under worksheet 2. Instead, report the gain from your business worksheet on form 4797. In this presentation, we will discuss the question of how much is taxable with relation to the tax consequences of selling your home. This information can be found in publication 523. How much is taxable? Review of the eligibility test. Generally, your home sale qualifies for the maximum exclusion if all the following conditions are true. So as we go here, we're emphasizing in on the exclusion now. So this is going to be the key point. Note where the exclusion is in the calculation. We've already calculated the gain, and now we're thinking about the exclusion when considering this component. So we're down here basically in the calculation. Back to the text. You didn't acquire the property through a like-kind exchange in the past 5 years. You aren't subject to the expatriation tax. You owned the home for 2 of the last 5 years and lived in the home for 2, 1 if you became disabled, of the last 5 years leading up to the date of sale. And for the 2 years before the date of the current sale, you didn't sell another home on which you claimed the exemption. The sale doesn't involve the transfer of vacant land or a remainder interest. So this is basically a review of these items. We took a look at these items in the past. If you want to see more detail on these individual items, you can take a look at prior presentations. Next, we'll take a look at some detail related to this item and then related to this item. So first, detail related to you owned the home for 2 of the last 5 years and lived in the home for 2, 1 if you became disabled, of the last 5 years leading up to the date of sale. If this condition isn't met, your home may qualify for a partial exclusion. The sale must involve one of the following events experienced by you, your spouse, or a coworker: a work-related move, a health-related move, a death or divorce, a pregnancy with multiple children, a change in employment status, a change in unemployment compensation eligibility, or another unusual event. Next, we'll take a look at an item related to this one. The sale doesn't involve the transfer of vacant land or a remainder interest. The transfer of vacant land or of a remainder interest may qualify for the maximum exclusion, but specific rules apply to those situations. For a step-by-step guide to determining whether your home qualifies for the maximum exclusion, see, does your home sale qualify for the exclusion of gain above? So we've taken a look at these items in more detail, but of course the exclusion is going to be one of the huge components with relation to the home sale. So we want to review it here as we move forward. Back to the text. If you qualify for an exclusion on your home sale up to $250,000, $500,000 if married and filing jointly, of your gain will be tax-free. If your gain is more than that amount, or if you qualify only for a particular exclusion, then some of your gain may be taxable. So again, that's going to be the major component here with the home sale is the exclusion. That's going to be the major benefit we have. Note where it is in the calculation. It's going to be down on the bottom. So we're not talking about the exclusion with relation to the sales price. If we sold it for, $1 million in this case, we're not comparing the $500,000 exclusion to the sales price. We're comparing it all the way down here to the gain. So the sales price minus the adjusted basis gives us the gain. Then we apply the either $250,000 or $500,000 maximum exclusions for married filing joint or single or married filing joint. Obviously the married filing joint being the higher exclusion. So this would be the married filing joint exclusion. Then we may have some tax consequences on the amount over and above the exclusion. But again, note that's a really large, of course, exclusion. Back to the text. This section contains step-by-step instructions for figuring out how much of your gain is taxable. See Worksheet 3 later for assistance in determining your taxable gain. If you determined in Does Your Home Sale Qualify for the Exclusion of Gain earlier that your home sale doesn't qualify for any exclusion, either full or partial, then the entire gain is taxable. So if we went through those lists that we went through, we recapped them here. We went through them in more depth in prior presentations. If you don't qualify for this exclusion, then you could potentially, whatever the gain is, could be taxable. So when we're thinking about the home, we're really hoping, we're really trying, we're really looking to see that we can qualify for the exclusion. So it's well worth, in many cases, to plan to make sure that you're in compliance with the qualifications for the exclusion, so that you could take advantage of it, big giant tax benefit for the sale of the home. Back to text. If you don't have a gain, you owe no tax on the sale. So that seems obvious, but let's make that clear here. If we sold the home for even $1 million and the cost of the home cost more than $1 million, in other words, the adjusted basis is more than $1 million, then even though we got $1 million on the sales price, we didn't really earn anything, because if the cost of it costs more than that, we would have a loss. We wouldn't have a gain, but a loss. And we wouldn't, in that case, even need the exemption typically, because the amount of the cost was greater than the amount we sold it for, therefore resulting in a loss. And the IRS, tries only to take our money when we have income. So if we have income, that's when the IRS takes our money. If we lose money, then the IRS isn't our partner anymore. But if we make money, then they're our partner and we owe them, part of it. So that's how it works. So back to the text. In either case, you don't need to complete Worksheet 3, and you can skip to reporting your home sale later. Recapturing depreciation. So remember, when we think about depreciation, we're considering the basis down here typically. So we have the cost, the sales price, and then the basis, how much we bought the home for. So what if we had some depreciation, which is the allocation of the cost? It's basically a tax benefit throughout the use of the home in some way. If we were able to deduct depreciation, now we got a benefit for allocating that cost. That usually affects the amount of the cost. The basis then should be adjusted for the benefit we got in the past for depreciation. Back to the text. If you use all or part of your home for business or rental after May 6, 1997, you may need to pay back, recapture, some or all of the depreciation you were entitled to take on your property. Recapturing depreciation means you must include it as ordinary income on your tax return. So let's think about how that might work. If we go back to our calculation and we think about the cost, what is depreciation? It's, as we said, the allocation of the cost. So you might think that it should be sufficient if, when we sell the house, that we should just basically be able to adjust the cost for the amount of depreciation that was taken in the past. That would result in a higher gain, and that higher gain then would compensate in the year of sale. But there's some other problems involved here, and one is the fact that if we got the depreciation, we got it probably at ordinary income rates, which are usually favorable compared to the rates for the capital gains rates, which is what we're going to be taxed at if we sell it. Plus there's this huge exemption on the home. So the IRS in some cases might say, well, we need you to, whatever depreciation you took in the past, we want you to just include that as revenue on the income at the point of sale, and that way you're going to have to pay taxes on it with relation to the ordinary income rates, and it's not going to be subject to the exclusion. It might not be wiped out by the exclusion. And so you can see how that might end up happening, given the fact that this exclusion is kind of a special exclusion just for the home sale, and the depreciation was taken with relation to basically business use or rental use typically. So they're going to say in some cases then the recapturing depreciation means you must include it as ordinary income on your tax return, which means it's going to go on basically the 1040, and typically you have to pay the ordinary income rates on that. In this presentation, we will discuss reporting your home sale. This information can be found in Publication 523. Reporting your home sale. This section tells you how to report taxable gain, take deductions related to your home sale, and report income other than the gain that you may have received from your home sale. This section also covers special circumstances that apply to some home sellers. What records to keep. Anytime you buy real estate, you should keep records to document the property adjusted basis. In general, keep these records until 3 years after the due date for your tax return for the year in which you sold your home. So 3 years is typically the kind of a statute of limitations. The IRS can come back with no reason at all. They can just randomly basically pick the tax return and come back and take a look at it. Now, if they have reason, then they could come back in like a 5-year period. And if they think there's fraud or something like that, they could come back basically at any time. So if it's something as big as a home sale, then I would typically keep that for at least 5 to 7 years. I would probably have that around. And note, you want to be able to log in the basis calculation. Make sure you have a worksheet, something like this, some type of worksheet that shows the basis calculation. Because if someone comes back and asks about it 3 years later, even if you did it very diligently and you were completely correct with everything you did, it's going to be difficult to go back and remember what happened. And you want to not have to remember what happened. You want to be able to log down, pull out exactly what happened, be able to read it, be able to understand it, be able to explain it to somebody else who probably isn't as familiar with the information, and explain to them how it was derived. Back to the text. Reporting gain or loss on your home sale. Determine whether you need to report the gain from your home. You need to report the gain if any of the following is true. So first question, of course, do we need to report it? Because note, as we see with the example here, if there's a huge exemption, like a $500,000 exemption, then we may not have any gain or loss after that exemption. So the question is, do you have to put it on the return in that case or not? Or when do you have to put it on the return? What if we had a loss or something like that? Or in different circumstances, what do we have to report on the return? Back to the text. You have taxable gain on your home sale or on the residential portion of your property if you made separate calculations for home and business and didn't qualify to exclude all the gain. So obviously in this case, we only qualified to exclude some of the gain, and there was still some gain that didn't qualify. In other words, the gain was greater than the exemption amount, and that would mean we'd have to pay tax. So of course we'd have to report it so that we can pay tax on it. Back to the text. You received a Form 1099-S. If so, you must report the sale even if you have no taxable gain to report. So if we got the 1099-S, we're basically going to put it on the return, show it on the return. Note that the 1099-S is also going to go to the IRS. So the IRS is going to see this 1099-S. It's kind of like a W-2 in that they're going to say, wow, this person, applied to this social security number, because all we are is a number to the IRS, right? This social security number person, taxpayer, person that gives us money has, got a lot of money. That's what they see. They don't see what the cost was on their side. No one sends them a 1099 showing them how much the home cost, or whether or not it's, the principal residence, does it qualify for all the principal residence rules and whatnot. They don't know that. So if we don't give them the information on a tax return, the IRS is basically not gonna know that, and their default assumption is this person owes us money, right? And so they're more likely to go out. So what we want to do is basically report it, say, hey, I qualify for the exemption. Here's the cost of the property. I don't owe you anything according to the rules here. Back to the text. You wish to report your gain as a taxable gain even though some or all of it is eligible for exclusion. You may wish to do this if, for example, you plan to sell another main home within the next 2 years and are likely to receive a larger gain from the sale of that property. If you choose to report rather than exclude your taxable gain, you can undo that choice by filing an amended return within 3 years of the due date of your return for the year of sale, excluding extensions. If none of the 3 bullets above is true, you don't need to report your home sale on your tax return. If you didn't make separate home and business calculations on your property, skip to reporting deductions related to your home sale later. If any of the 3 bullets above is true, skip to determine whether your home sale is an installment sale later. If you made separate gain-loss calculations for business and resident portions of your property, in other words, if you had to break it up between the business and portion and the business and the non-business or resident portion, then we go here. You may have to use Form 4797 to report the sale of the business or rental part. So for that, then it would be more of a business type sale for the business or rental part, as we've discussed in prior presentations. Then we want to see business or rental use home that we've talked about or looked at earlier. Determine whether your home sale is an installment sale. So now we want to think about, well, is it an installment sale? If you finance the buyer's purchase of your home, you hold a note, mortgage, or other financial agreement, you probably have an installment sale. You may be able to report any non-excludable gain on an installment basis. Use Form 6252 installment sale income to report the sale. For more information, see Publication 537 installment sale. So that's going to be a circumstance specific to the installment sales. We're not going to get into a lot of detail on installment sales. We might do that at a later time. But if you have questions or if you fall into the category of installment sales, then you can take a look at Publication 537, IRS website, irs.gov. Type in pub or publication 537, installment sales. Report any interest you received from the buyer. If the buyer is making payments to you over time, as when provider-seller financing, then you generally must report part of each payment as interest on your tax return. Report the interest portion on the payment as ordinary income on Form 1040, line 2B. If the buyer is using a property as a first or second home, also report the interest on Schedule B, Form 1040. So this is the normal reporting for interest on the 1040. On Schedule B if necessary, and on the front page of the 1040, back to the text, interest and ordinary dividends to Form 1040 and provide the buyer's name, address, and social security number. There's a $50 penalty per requirement for failing to meet any of these requirements. So that's going to be if you don't meet the requirements of the reporting requirements, then you could have a penalty of the $50. If you're a non-resident or resident alien who doesn't have and isn't eligible to get a social security number, you may be issued an individual taxpayer identification number, which is an ITIN, ITIN. If you didn't have an ITIN, apply for one by filing Form W7, application for IS, individual taxpayer identification number. If needed, a non-resident or resident alien buyer can apply for an ITIN as well. So again, whether we're a resident or a non-resident, IRS, we're just a number. We need a number. IRS doesn't know what to do if we don't have some type of number. So back to the text. Complete Form 8949, Sale and Other Dispositions of Capital Assets. Use Form 8949 to report gain from the sale or disposition of the personal use portion of your home if you can't exclude the gain. Tip: if you have gain that can't be excluded, you generally must report it on Form 8949, Sale and Other Dispositions of Capital Assets, and Schedule D, Form 1040, Capital Gains and Losses. Report the sale on Part 1 or Part 2 of Form 8949 as a short-term or long-term transaction depending on how long you owned the home. So short-term or long-term, was it less than a year? Typically it would be long-term, over a year. Back to the text. In addition, you may be able to temporarily defer capital gains invested in a qualified opportunity fund. You may also be able to permanently exclude capital gains from the sale or exchange of an investment in a QOF if the investment is held for at least 10 years. For more information, see instructions for Form 8949. Complete Schedule D, Form 1040, Capital Gains and Losses. So this is going to be the form that would be used. And note, we took a look at an example of this in prior presentations, and we've got the 1040 or Test 1040. Schedule D you may be familiar with as the schedule you would have if you sell stocks, or stock sales are typically reported here because it's a capital gain. So we're talking about capital gains. The sale of the home would be a capital gains. But of course, the sale of the homes has that special circumstance as well, which is the exemption calculation. So Schedule D down here, we're in the Part 2, long-term capital gains and losses. Sales price in our example, we took this basic calculation. The sales price minus the selling costs gives the amount realized after the cost, and then the basis calculation here, that gives us our gain, $632,600. Then we had the exemption of the $500,000, giving us the gain that could be taxable. And if we go to the practice worksheet, then this is going to be a worksheet that you can find in the publications or get a copy. We'll provide a copy as well. And you can go through the worksheet and basically fill this information out in order to get to this gain amount, and then fill that out into the worksheet here. You'll see a similar worksheet on this item. So we have the sale of home, gain, loss, exclusion, type of worksheet, the sales price, the 1 million, selling expenses, the 47,400. And then if we subtract that out, we've got the 953,600, the adjusted basis, 320. That gives us our gain of the 632,600. This is a married filing joint. We're saying they qualify for the maximum exemption, 500,000. So there's the 500,000, bringing the amount taxable to 132,600. Taxed at capital gains rates, which are typically, could be like 0, 15, or 20. They're typically more beneficial usually than the ordinary income rates. Even the taxable amount note, just remember, however, you're not talking about ordinary income rates when you start thinking about adjustments to these type of things. And then of course that number pulls forward, this 132,600 pulls forward to the Schedule 1. So here it is on Schedule 1, pulls forward to the 1040, and you'll see it here on the 1040. There it is here, included in line 6, tax then calculated on it. Back to the text. Using the information on Form 8949 on Schedule D, Form 1040, the gain or loss on your home as a capital gain or loss. Follow the instructions for Schedule D when completing the form. Here too is Form 8949. So 8949, we have this calculation. We have it on Schedule D, and then it flows. We have the rest flowing through as we saw before. Back to the text. If you have any taxable gain from the sale of your home, you may have to increase your withholding or make estimated tax payments. See Publication 505, Tax Withholding and Estimated Tax. Note, of course, that if you think that you're going to have a gain, and a sale of a home could be substantial, right? If you have that could be a substantial increase in income, then you're going to have an increase in the tax resulting in that. So you're going to have an increase in the tax, and the IRS wants to be paid throughout the year. So just waiting till the end of the year, you might say, well, I'll just pay that at the end of the year. I'll have the home sale and then I'll pay it at the end of the year. You could do that, but the IRS will charge you interest and penalties most likely because they want to be paid throughout the year. So they want their money, when it happened kind of. So you need to adjust basically withholdings or make some kind of estimated payments if you think that you can have a large difference in the taxable income, and that might help to avoid any kind of interest or penalties that could result with regards to the change in the taxes due to a home sale. In this presentation, we will discuss reporting deductions related to your home sale. This information can be found in Publication 523. Reporting deductions related to your home sale. If you aren't itemizing deductions on your return for the year in which you sold your home, skip to reporting other income related to your home sale. Remember that the itemized deductions will be the Schedule A deductions. We have the itemized deductions. Two of the major itemized deductions, of course, being the home mortgage interest and the taxes on the real estate. Those two things often being associated with the home ownership. If we take a look at the 1040, you'll recall that the itemized deductions would need to be greater than the standard deductions, which you can see on the left side, single, 12,000, married filing joint, 24,000. The ownership of the home, often one of the things that pushes many taxpayers over that qualification. Note that this threshold is much higher in 2018 than in prior years because the standard deductions have increased. And therefore, when we think about whether or not we are going to be itemized or itemizing as opposed to taking the standard deduction, those could change significantly from 2018 as compared to prior years, given the fact that the standard deduction is higher. Remember that the itemized deductions need to be greater than the standard deduction in order to have a benefit for them. Back to the text. There's no tax deduction for transfer taxes, stamp taxes, or other taxes, fees, and charges you paid when you sold your home. However, if you paid these amounts to the seller, you can treat these taxes and fees as selling expenses. If you paid these amounts as the buyer, include them in your cost basis of the property. Determine the amount of real estate tax deductions associated with your home sale. Depending on your circumstances, you may need to figure your real estate tax deductions differently. See the discussion that follows for more information. So now we're thinking about the real estate taxes that we pay, so the property taxes that we have. Note that property taxes is one item that could be reported on the Schedule A. So one item that if we pay property taxes and we own the home outright and we didn't have any sale or anything happening, typically it's something that would be included on the Schedule A as something that could qualify us for itemizing. Back to the text. If you didn't receive a Form 1099-S, use the following method to compute your real estate tax deduction, which may be different from the amount of real estate tax you actually paid. Divide the number of days you owned the property during the year of sale, not counting the date of sale, by 365 or 366 for a leap year. So 365 typically being the days in a year, 366 if leap year. Multiply that figure by the amount of real estate tax due on the home during the 12-month billing cycle that contains the date of sale. The result is the amount of real estate tax you can deduct as an itemized deduction. Example: the real estate tax on Dennis and Beth White's home was $620 for the year. The real property tax year was the calendar year with payment due August 3rd, 2017. They sold the home in May, so they sold it in May 2017. Dennis and Beth are considered to have paid a proportionate share of the real estate taxes on home, even though they didn't actually pay them to the taxing agency. Dennis and Beth owned their home during 2017, real property tax year for 125 days. So we're calculating 125 days of the 360 days. So that's going to be January 1st through May 5th. And again, we're just counting up the days. You obviously remember to take into consideration how many days are in each month. So 31 days in the first month, 28 in the second month, and so on. The days before the sale, they figure their deduction for the taxes as follows. So here's going to be the calculation. They got the total real estate taxes for the real property tax year. That's going to be the 620. And then they're going to take the number of days in the real property tax year that you owned the property. So we owned the property 125. And then we take that line 2, the 125, and divide it by the number of days in the year. So 125 divided by 365 or 366 if it was leap year gives us 365 in our case, gives us the 0.342. And then line 4 says multiply line 1 times line 3. This is your deduction entered on 5B of Schedule A. So then we would take that amount. That's what we would use then to go to the Schedule A, put that on 5B, which is the state and local real estate taxes. Since the buyer paid all the taxes, Dennis and Beth also include $212 in the home's selling price. So the other amount, you might say, well, they still paid it. Why don't we get the deduction on Schedule A? But because they didn't own the home for the whole year, they only owned it for part of the year. They paid property taxes for part of the home that wasn't actually theirs for part of the year, and therefore it should be part of the transaction for the sale type of transaction. So the buyer adds the $212 to their basis in the home. The buyer can deduct $408, which is the $620 minus the $212, as an itemized deduction, the taxes for the part of the year they owned the home. If you received a Form 1099-S, start with the amount of real estate tax you actually paid in the year of sale. Subtract the buyer's share of real estate tax as shown in box 6. The result is the amount you can deduct as an itemized deduction. So hopefully if you do get the 1099-S, you can follow the instructions here. If you didn't actually deduct all your mortgage points on an earlier tax return, you may be able to deduct them on your tax return for the year of sale. You can see publication 936, Home Mortgage Interest Deduction, for more information on that. IRS website, irs.gov. Take a look or type in publication or PUB 936. Report on Schedule A 1040, itemized deductions, any itemized real estate deduction. Follow the instructions for Schedule A when completing the form.